hitting our constituents where it hurts. It is clear the Fed is not satisfying its price stability mandate. I look forward to hearing from you on the path forward to address the monetary policy side of this equation. I yield back.
I want to welcome our distinguished witness today, the Honorable Jerome Powell, the Chair Pro Tempore of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. Chair Pro Tempore Powell, you are now recognized to present your oral testimony.
Thank you. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. Before I begin, let me briefly address Russia's attack on Ukraine. The conflict is causing tremendous hardship for the Ukrainian people. The implications for the U.S. economy are highly uncertain, and we will be monitoring the situation closely. At the Fed, we're strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. We pursue these goals based solely on data and objective analysis, and we're committed to doing so in a clear and transparent manner so that the American people and their representatives in Congress understand our policy actions and can hold us accountable. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but with cases having declined sharply since mid-January, the slowdown seems to have been brief. The labor market is extremely tight. Payroll employment rose by 6.7 million in 2021, and job gains were again robust in January. The unemployment rate declined substantially over the past year and stood at 4% in January, reaching the median of FOMC participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has ticked up, labor supply remains subdued. As a result, employers are having difficulties filling job openings. An unprecedented number of workers are quitting to take new jobs, and wages are rising at their fastest pace in many years. Inflation increased sharply last year and is now running well above our longer-run objective of 2%. Demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus, and price increases are now spreading to a broader range of goods and services. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. The committee will continue to monitor incoming economic data and will adjust the stance of monetary policy as appropriate to manage risks that could impede the attainment of its goals. The committee's assessments will take into account a wide range of information, including labor market conditions, inflation pressures and inflation expectations, and financial and international developments. We continue to expect inflation to decline over the course of the year as supply constraints ease and demand moderates because of the waning effects of fiscal support and the removal of monetary policy accommodation. But we are attentive to the risks of potential further upward pressure on inflation expectations and inflation itself from a number of factors. We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market. Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. The process of removing policy accommodation in current circumstances will involve both increases in the target range of the federal funds rate and reduction in the size of the Fed's balance sheet. As the FOMC noted in January, the Fed funds rate is our primary means of adjusting the stance of monetary policy. Reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. The near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war with sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. Maintaining the trust and confidence of the public is essential to our work. Last month, we finalized a comprehensive set of new ethics rules to substantially strengthen the investment restrictions on senior Federal Reserve officials. These new rules will guard against even the appearance of any conflict of interest. They are tough and best in class in government here and around the world. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Chair Pro Tempore Powell, as you know, the Fed is required to conduct monetary policy in a manner that fulfills its dual mandate to promote maximum employment and stable prices. But as you have explained, most of the inflation we're experiencing right now can be traced back to supply chain issues related to the pandemic, and the Fed cannot directly affect supply side conditions. These supply chain constraints seem likely to only significantly increase as Russia invades Ukraine and the full effect of our sanctions take hold. If the Fed's tools are mostly useful in stimulating or constraining demand, how can we expect monetary policy to rein in inflation that is largely driven by supply side factors?
Our policies really cannot, as you point out, affect supply-side conditions. Our policies affect demand. What we're facing now is, though, an elevated level of demand in the face of supply-side constraints, and it's the collision of those two things that's creating inflation. So there is an important job for us to move away from these very highly stimulative monetary policy settings to a more normal level of rates and perhaps tighter at a time when inflation is highly elevated, and that is what the committee plans to do.
So it seems clear that the Fed has limited tools to address inflation and that Congress has an important role to play. The Monetary Policy Report notes major shortages in housing supply as a factor in high prices. If Congress were to make investments to alleviate these shortages, do you think this would be helpful in addressing inflation?
Major investments in housing supply. So I think housing prices are high for a number of reasons, actually. Difficulty in getting lots, materials, difficulty in finding workers, very high demand. It's been extraordinarily high. So those are many of the features, and also low interest rates have made credit widely available. Mortgage rates are going up. That will probably begin to cool off demand. I wouldn't want to comment on congressional legislation, but I do think there's no doubt a role for Congress.
So I suppose I could conclude, without having you comment directly on fiscal policy, that you agree there are ways to manage inflation outside of monetary policy. It's not only monetary policy, that others have a role to play.
I do think that's right, but more in a sort of medium or longer term sense. I think the Fed does monetary policy, and inflation is largely a monetary phenomenon, and it's our tools that can be used to address inflation. Over time, though, of course, anything that expands the productive capacity of the United States over time would, in principle, make greater potential output and a less constraining economy.
Fed forecasters expect that inflation will subside as supply chain disruption issues are resolved. However, housing and rent prices, as you've said, account for roughly 1/3 of the consumer price index, and most economists do not expect the problem to be resolved as quickly as supply chain bottlenecks due to both the time it takes to develop housing and the lack of investment in housing that is affordable to low and moderate income families. Currently, there's a shortage of nearly 7 million rental homes that are affordable and available to America's lowest income renters, and a shortage of more than 5 million homes for potential home buyers. In my district, there's a shortage of more than 34,000 rental homes that are affordable and available to the lowest income families, while the state of California has a shortage of more than 962,000 affordable rental homes. If Congress does not make the investments to increase supply and access to the affordable homes in this country, how concerned are you that the Fed will not be able to contain inflation?
Well, you're right that housing inflation is a significant part of the CPI. We also look more prominently at personal consumption, PCE, which is a different measure, and it's something less than that. And unlike these temporary supply-side constraints that we see, housing inflation really is much more of an indicator of the tightness of the economy rather than supply-side problems. So it's something we watch carefully along with wages, frankly, and it is a major contributor to inflation. As I mentioned, higher interest rates housing is a very interest-sensitive sector, and higher interest rates, really interest rates that move back toward a more normal level, should act to cool off the housing market over time.
Thank you. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Well, thank you, Madam Chair. Chairman Powell, thank you for your leadership in tumultuous times, and this is certainly interesting times internationally, challenged times internationally. Everyone else on the Open Market Committee, it seems, has opined about the March meeting. Everyone, whether it's a tweet or an interview or anything else. What are your thoughts going into the March meeting?
The March meeting. Okay, so here's how I'm thinking about the March meeting. I guess I would start, of course, with the U.S. economy, which is very strong, the labor market extremely tight, and inflation running well above target. The way we think about our work is we develop working plans for making adjustments to monetary policy over the course of the coming months, and then we are flexible as plans meet the real world. So we're never on autopilot, obviously, and at a time like this, what we aim to do is lay out our principles and then, with whatever clarity we do have, and then proceed to implement those policies carefully and nimbly. So coming into this meeting, let's say before the Ukraine invasion, the committee was set to raise our policy rate, the first of what was to be a series of raises expected for this year. Every meeting was live. Decisions would be based on incoming data and the evolving outlook. I also expected we'd make great progress on our plan to begin to shrink the balance sheet. And so the question now really is how the invasion of Ukraine, the ongoing war, the response from nations around the world, including sanctions, may have changed that expectation. And so it's too soon to say for sure, but for now, I would say that we will proceed carefully along the lines of that plan. The thing is, the economic effects of these events are highly uncertain. So far, we've seen energy prices move up further, and those increases will move through the economy and push up headline inflation, and also they're going to weigh on spending. We're seeing effects on other commodities and perhaps from declining risk sentiment and weaker growth abroad. The thing is, we can't know how large or persistent those effects will be. That simply depends on events to come. So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. We're also going to write down our new summary of economic projection, individual forecasts, which will show each participant's views of the path forward in the economy and with rates. I also expect that at this meeting, we'll make good progress toward an agreement on a plan to shrink the balance sheet We will not finalize that plan at this meeting. We'll do that when we think the time is right at a coming meeting. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. We use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think about it.
Very specific. Now, you mentioned 25 basis points. From all the analysis about what the Fed will do over the course of the next year, is 25 basis points the floor, the ceiling? Is it the speed limit? Is that the max you think the Fed could take on? How do you think of that?
So here's how I think about that. We have an expectation. Those of us on the committee have an expectation that inflation will peak and begin to come down this year. And to the extent inflation comes in higher or is more persistently high than that, then we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings.
Now, you mentioned the balance sheet, a plan for the balance sheet, and that is to come. But what I'm hearing clearly from you is that the Fed is very interested in financial stability given what's happening, and you're willing to make quick decisions on a question of liquidity, on a question of market stability, those important works that you've focused on as Fed chair. And so it's actually substantial news for the House to be the first rather than the Senate to break news. So thank you for your forthcoming, being so forthright about your views on this. And with that, Madam Chair, I yield back.
Thank you. The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Madam Chair, and thank you for Ranking Member for holding this hearing. Chairman Powell, thank you very much for being with us here once again. As we look at the unprovoked criminal Russian invasion of Ukraine, one of the most notable national security responses has been the President's recent announcement to cut off much of the Russian financial sector from SWIFT financial services. Our EU partners have also joined us and excluded 7 Russian banks from SWIFT. Chairman Powell, what practical effect would this have on Russia, its economy, its financial sector, and its people?
So thank you. I should point out that the Fed does not impose sanctions on other countries, that we, in this process of developing sanctions, we are not a principal. That's really a job for the administration, particularly the Treasury Department. So we provide technical background support and things like that. But I think questions about sanctions and their effects generally would be more for the administration and the Treasury Secretary. I think you can see, I will just add, though, that the effects of the sanctions so far appear for now to have been significant.
Yeah, I mean, we saw what happened to the ruble. We saw what happened to the market. The market's still closed. Is a way around it for them cryptocurrency? Could you talk a little bit about that? I know it's a little bit out of your bailiwick, but as you said, it's an interesting moment in time. You know, we haven't had to face this since really World War II, and even all the comments that you made about inflation and watching the market, so much of it is tied to obviously what the Russians are doing with respect to their unwarranted and criminal act there in Ukraine.
So I don't have any private information on the extent to which that is happening, but that is something you read about and hear about. And I just think it underscores the need really for congressional action on digital finance, including cryptocurrencies. We have this burgeoning industry which has many, many parts to it. And there isn't in place the kind of regulatory framework that needs to be there. It was probably no different with railroads or telephones or the internet. And ultimately, what's needed is a framework, and in particular, ways to prevent these unbacked cryptocurrencies from serving as a vehicle for terrorist finance and just general criminal behavior, tax avoidance and the like. So I guess that's what I would say there. I don't really know the extent to which it's happening, although you do hear that and read it in the paper.
seems like an out for them. Since we did go down this road, could you comment a little bit about then the central bank digital currency? It seems like that would be something that would be helpful in situations like this.
Yes, so we issued a paper after much thought and many drafts. We issued a paper, was it late last year? I guess it was late last year, seeking public comment on the costs and benefits of a potential central bank digital currency issued by the Federal Reserve here in the United States, digital dollars. And we await, I think we gave an extended comment period, and we gave, and we very much look forward to reading those comments. This will be something that we invest a fair amount of time and expertise and hiring people and things like that to try to get it right, but also to understand whether the benefits actually outweigh the costs, which I think is an unanswered question both here and around the world. Nonetheless, it's our obligation to move vigorously to understand the answers to that question so that we can deploy a central bank digital currency if it's appropriate. So would it, in principle, it depends on why people are using unbacked digital currencies. If they're using them to evade, visibility and evade the law, then for us just to have a law-abiding CBDC won't change that. They'll still be able to use those currencies for that matter. The existing digital currencies that again are not backed are really vehicles for speculation. They're not used in payments. They're not a store of value. They're speculation like gold. That's what they're used for. Whereas, potentially a U.S. CBDC would have a wider view. I do want to stress we have not decided to do it, but we do understand our obligation is to really get to the bottom and understand both the technical and the policy issues that need to be answered.
Thank you, and I know my time's about up. I'd just say from your lips to God's ears, I hope that the inflation does peak this year and does come down because people are hurting. And thank you very much again for your steady stewardship.
Thank you very much.
Thank you.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Welcome, Chair Powell. It's good to see you in the chair. We appreciate your time and service. Chair Powell, since the last FOMC meeting in January, the global economy has become markedly more complex. Russia's unprovoked and unwarranted invasion of Ukraine has led to a very steep increase in the price of energy. As of this morning, when I checked, a barrel of crude oil was priced at $112 per barrel. And this steep increase in the price of energy risk pushing U.S. inflation potentially even higher. How does, and you've touched on it a little bit, but how does the war in Ukraine affect your thinking as you prepare for the next FOMC meeting?
So I think the first thing, again, to say is that the ultimate economic effects of the war and all of the sanctions and events yet to come are just very highly uncertain, and we need to understand that. And so, as I mentioned, I think it's appropriate for us to move ahead. Inflation is high. The committee is too high, and the committee is committed to using our tools to bring it back down to levels of price stability, which is to say 2% inflation. So, but I would also say that given the current situation, we need to move carefully, and we will. And we'll be nimble. We'll be looking at the situation as it evolves. And again, we will use our tools to add to financial stability, not to create uncertainty.
So at this point in time, you don't think that it significantly alters your expectations for the rate increases that you've discussed this year?
I don't think that's knowable yet. I mean, so we've run what we like to do is run alternative scenarios, and we've done some of that, as you would expect. And it's easy to find cases where it would affect, but we don't know that yet. We honestly don't, and we'll see.
Thank you. Chair Powell, could you explain the role of the Federal Reserve in implementing U.S. sanctions on Russia? How you're working with OFAC, how this actually is implemented? Right.
So sanctions are really designed by the administration. They're part of what the elected government does, where we provide technical support. We implement those sanctions, or we make sure that the banks obey them, that we supervise and regulate. That's one thing that we do. We also consult on, we have knowledge about financial markets and financial institutions, so we're providing technical support, but we're not the decision makers on those things. And honestly, these are decisions that are made at the level of the government, not at the level of the elected government, not at the level of the Fed.
And I know things are happening quickly and in real time here, but what actions has the Fed taken to date since the invasion of Ukraine?
Well, I'd say, first of all, since late last year, we've been on very high alert for cyber attacks. We haven't seen any notable incidents about that yet. We consult. We're making sure that the banks we regulate and supervise are also on high alert. We communicate with the reserve banks where there's a lot of expertise in these areas and other parts of the government. So that's one thing that we've done. We're, as I mentioned, we are in very close contact with the Treasury Department, as you would expect, between every central bank and every finance ministry around the world. But again, we're not the ones who design the sanctions.
Right. Well, cybersecurity is certainly, this committee is, and especially at the Fed, is a top priority. I'm glad that you're watching it closely. Chair Powell, does our U.S. financial system have the necessary capital and liquidity to handle any economic fallout from this war? What kind of data will we be seeing?
I mean, the evidence to me strongly suggests that the answer to that is yes. We just went through a rather enormous shock with the pandemic and the near closure of the global economy, and U.S. banks' capital levels are at multi-decade highs, liquidity levels the same. It's hard for me to look at that and say that a lack of capital is a threat at this point. There are certainly issues. Cyber for private financial institutions is a huge issue, and one that they spend a great deal of time on, as do we.
In 2015, the Obama administration blocked the development of the Keystone XL pipeline, a decision reversed by the Trump administration, and President Biden canceled the permits, again, depriving the U.S. of over 800,000 barrels of oil a day. Wouldn't expanding the supply of oil by 800,000 barrels a day reduce energy inflation and lower prices at the gas pump?
We're not responsible for energy policy. That's a matter for Congress and the administration. Of course, the laws of supply and demand do work.
Laws of supply and demand do work. I've used my time and I yield back.
Gentleman from Guam, Mr. San Nicolas, is now recognized for 5 minutes.
Thank you so much, Madam Chair. Good morning, Chair Powell. And I'd like to first recognize one of my senators all the way from Guam, Senator James Moylan. Thank you so much for making time to join us here today, Senator. Mr. Chairman, over the course of the uptick of inflation in the last year, you testified before the committee on multiple occasions that the Fed believed that the inflation that the country was experiencing was transitory. And since that time, especially today, there's a seeming change in that tenor. Could you elaborate more on that?
Sure, I'd be glad to. So I think very widely among macroeconomists and other central banks around the world, we looked at it as akin to an energy shock and a supply-side shock. And the textbook on monetary policy would have you look through that, because a supply shock comes and goes, and by the time monetary policy is having its effect, which happens with long and variable lags, we think, the supply shock is already gone. So we looked at it that way, and I think that we expected to get relief, particularly going into last fall, I would say. We expected when schools reopened, vaccinations, raised, kids back in school. We expected supply of labor to come in, that kind of thing. And it didn't happen. But it didn't happen because the supply side constraints didn't ease. They didn't ease. So it's not like, as a practical matter, what was wrong was not the theory. It was just, in reality, the supply side constraints have been much, much more durable and persistent than we had expected. So we knew that we could be wrong, and I think I always thought we could pivot pretty quickly and catch up. And we did pivot when we started to pivot in the middle of last year, and then pivoted hard at the end of the year. But in the meantime, the economy was really healing incredibly quickly over the second half of last year. record job growth and record decline in unemployment, record tightening in the labor market. So, we know that what our job is now, which is to move away from these highly accommodative settings to more appropriate settings, given the very hot nature of the labor market and the level of inflation.
There's chatter, Mr. Chairman, public chatter, that the intensity of the inflation that we're dealing with today is a reflection of the Fed not taking policy action soon enough, not taking enough policy action. And there's chatter, public chatter, that causes the Fed's credibility to come into question as to whether or not it is acting responsibly and appropriately with the data sets that are coming in. And I bring this up, Mr. Chairman, because we have a duty to the American people to be able to raise these questions as pointed as they are, and to give individuals such as yourself an opportunity to really speak to the credibility question that's really out there in the community. If you could elaborate further on that.
Sure. It's for others to judge many of the things you mentioned, and we understand that. But so we, starting in December, at our December meeting, we began talking about significantly more rate increases. The market took us very much at our word, and as this year has gone on, the market has so market participants do appear to be reacting, what I would call as appropriately to our assessment, our ongoing assessment and reassessment of what's appropriate. And I'll just assure you and everyone that we are committed to achieving price stability. We will use our tools to achieve price stability. Really, that is an essential bedrock element of everything else we want to achieve in the economy, including a strong labor market.
When we faced the financial crisis in 2008, a lot of lessons were learned about the need for the Fed to be more responsive to the liquidity traps that could take us by surprise. Given the circumstances we're dealing with today and the frustrations that the American people are facing, can you share with us any lessons that the Fed has learned with respect to its responsiveness to the inflation that we've been dealing with over the past 12 to 18 months and the intense inflation that we're dealing with today?
So the inflation that we're experiencing is just nothing like anything we've experienced in decades. It's higher, of course, much higher than anything we've seen since I was much younger. But not only that, it's different. It's coming from the goods sector. The goods sector has been a source of disinflation for a quarter of a century because so many goods, so many manufactured goods have been
But just specifically, Mr. Chairman, reclaiming my time, what specific lessons has the Fed learned from the outcome that we're dealing with today?
Well, I mean, we're still living through it. So the main focus we have is not on doing a retrospective. It's on conducting policy appropriately to return us to price stability while also sustaining the expansion.
Gentleman's time has expired. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, thank you for being here, and congratulations on your nomination to continue your job for a second term. I think it's well-deserved. Before I get to my questions, though, I want to hold up something here. This is a Ukrainian dollar. It's a hryvnia. I kept some of these when I was in Ukraine several years ago doing some ministry work, and I think it's interesting to think that what happens in the next few days may determine whether this is another defunct piece of currency and the nation returns to a ruble, or will this maintain some of its value? But as you look at it, you can see it's a fraction, physically a fraction the size of the U.S. dollar. It takes about 30 of these hryvnias to match a U.S. dollar, but when you look at values, our dollar has decreased in value, as you have mentioned, due to inflation. Now, a year ago when you testified before this committee, I asked what your outlook was for the economy, and you said you expected economic growth to be strong for the rest of 2021. But at that time, I warned that the $2 trillion stimulus bill that was making its way through Congress at that time was unnecessary and far too big, given the economy was already recovering. Lo and behold, these predictions came true. In your opening statement, you mentioned that you didn't expect inflation to continue at the rate it is right now, but I also recall throughout 2021, we heard that inflation was slight, it was going to be temporary, but I also understand that that prediction probably didn't include the actions and the roles that Congress had, as you had said. Now, according to a report from the Federal Reserve Bank of San Francisco, because the American Rescue Plan was so extremely large and was passed when the economy was already recovering, this was a significant contributing factor to inflation. Do you agree with that report from San Francisco's bank that our reckless spending is a contributing factor to our inflation?
I wouldn't like to comment on any particular law, but I'll say this. All of the things that we did after the pandemic were we turned our dials as hard as we could. So did you, with the CARES Act. And the economy did benefit from that. We have the strongest economy in the world now. But part of that, no doubt part of what we did and what Congress did without naming any particular laws is also part of the reason why inflation is high now.
Right. So there are multiple contributing factors to that, being reckless spending, which devalues our dollar, is one of those. And what we heard last night was that there is not going to be a change in the direction this Congress is going or the White House. It sounds like we're just going to repeat the same mistakes we made in 2021. Now, I know that you have the tools of adjusting the interest rate. You mentioned increasing 25 base points, and you mentioned that it may be necessary to go higher. Understand that. Do you still think that inflation will be temporary? And I believe that you said it would be short-lived going forward because of resolving our supply chain issues. But since there are other contributing factors to that, are you anticipating that Congress or the administration will undo some of the failed policies, such as the spending policies and the suppressing of America's energy supply, which has been a significant contributing factor? Let me rephrase that. If Congress and the White House does not change the policies of 2021 and continues down that same path, do you still believe that inflation will stabilize? Price stabilization will come this year?
Well, first, we've had this expectation, as you all know, for more than a year, and it hasn't actually come true. So we're humble about the fact that we can't really call with any confidence the turn, but it does seem that this year we'll be withdrawing policy accommodation. Actually, a lot of the fiscal policy spending has happened now, and so the impetus to growth will be declining and, in fact, negative from fiscal policy as it stands now. And those are things, and just the natural improvement of supply chains and labor supply and things like that. Those are the things we're looking to for relief on inflation, hoping for. Very difficult to say when they'll happen. And our job is to achieve price stability one way or the other.
Okay. I see I'm running out of time. I've got several other questions, but I'll submit those for the record. Now yield back, Madam Chair.
Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member, for this hearing, and thank you to Chair Pro Tempore Powell for joining us. It's been a challenging year. Rising prices at the gas pump and the supermarket cause real distress to working-class families like my neighbors in Chicagoland, and improvements in employment and wages are real, but not nearly enough. My constituents saw a decade of stagnation after the last recession. Working-class Latinos and immigrants like my neighbors are always hard hit. We simply can't afford that again. Chair Powell, you've said that inflation has been driven by bottlenecks in the supply chain, and last night President Biden highlighted their role in corporate concentration and price increases. I'll note that CEOs from Kimberly-Clark to Tyson Foods have bragged to investors about their power to raise prices without facing competition. And last night, President Biden said, and I quote, "Lower your costs, not your wages." And my constituents were glad to hear that. So, Chairman, can you explain how raising interest rates will lower prices for diapers or chicken? Last time it was because my neighbors lost their jobs and couldn't find diapers or chicken. So is that the idea?
Well, the idea is that right now the federal funds rate is still set close to zero, and that is a very stimulative level. I think it's 8 basis points today. So that is not an appropriate level, we think, going forward. We think it's appropriate that we engage in a series of rate increases over the course of this year and also let our balance sheet shrink. And so what will happen then over time is demand will moderate as interest rates get into the economy over time, and these annual price increases in everything where prices are going up will moderate as well. That is how it has always worked with interest rates. We don't do competition policy, so I can't really comment on that part of it. But I will say that that's how we think about inflation, and that's how we use our tools to get inflation under control.
Changing gears, we discussed corporate concentration, and last July, the president issued an executive order on competition that encouraged the Fed and other regulators to increase scrutiny of bank mergers. It's been a long time since regulators blocked a bank merger, even an acquisition by a globally systemically important bank, or GSIB, in 2020. Chairman Powell, do you think it's appropriate to issue a moratorium on pending mergers while the Fed updates its framework for their review?
Well, I think we have a statute that Congress has passed that gives us the rules for evaluating potential acquisitions and mergers by banks. I think we have a widely developed framework for that work, and we're continuing to implement that. I mean, any changes that would come would either come through legislation or through new personnel at the Fed, neither of which we have right now.
As we learned from Wells Fargo, frontline bank workers are an important resource for regulators. They see firsthand how banks implement or ignore internal controls, and they can identify problems as they develop. Incorporating frontline workers' voices in our banking regulatory system would improve the information we have and diversify the voices that get heard. Chairman Powell, will the Fed commit to adding bank workers to your various advisory councils? Why or why not?
Very interesting question. We do have quite a diverse group of people on our various advisory councils, including people who are representatives of workers. I don't know that I don't know that we have ones that work councils, outside councils that advise us on bank supervision per se, but we do always seek out in all of our reserve bank boards and also the advisory councils that we do have representation from labor and also from people who live and work in and represent the interests of, low and moderate income communities.
Thank you. Appreciate it if you would consider that. And Madam Chair, I yield back.
Thank you. The gentleman from Tennessee, Mr. Kostoff, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Powell, for attending this morning. If you can, a lot of times we look for historical references when we try to reference an event, a current event. A number of people, a number of pundits, when they look at inflation today, they reference it back historically to the late 70s and the early 1980s. From your perspective, is that the proper historical reference to what we're experiencing today as it relates to inflation?
That's the proper historical reference for what we're trying not to replicate. So we look back. Obviously, all of us have looked carefully at the history of post-World War II inflation and business cycles and all that kind of thing. One of the things that's different now is that central banks, including the Fed, are very squarely take responsibility for inflation. That was actually not the case in the 1970s. There was a school of thought that really there were certain things that an independent agency just couldn't do because it was too hard and Congress should do it. So now I think central banks around the world have an inflation target. They have transparency so that they can be held to account for it. You know, we're not waiting. We are using our tools now to, and that's really different than it was in the 1970s. So also inflation expectations have been anchored for a long time. They really weren't then. They were allowed to become unanchored without much of a response. That would not happen in today's world and will not happen.
A few weeks ago when the CPI number came out, I was on my way to a breakfast meeting in Jackson, Tennessee, where I represented one of my constituents and I, when we were talking about the new CPI number, he said, I don't care what the number is, because I know that I'm paying 50% more in gas than I did 12 and 18 months ago. I know I'm paying 20 to 25% more in grocery prices than I did a year ago. I know what the price of a new car and a used car is. If you were me, if you were a member of Congress, what would you tell your constituents about the rising cost, the expensive cost to just live today?
Inflation is too high. We understand that, and we're working on it. It's going to take some time, but we're going to get it back under control. By the way, we're seeing this everywhere in the world. We're seeing it more in the United States because our economy is stronger, but we're seeing it everywhere in the world.
Let me, if I can, follow up on a few questions that some of my colleagues asked about. Ranking Member McHenry asked you about the next meeting and your plans for the next Fed meeting, and I think you eloquently laid it out. But you also talked about the situation that's developed in Russia and Ukraine. My inference from your answer is that if Russia had not invaded Ukraine, that the Fed would be more aggressive as it relates to the balance sheet and to rate hikes. Is that a proper inference?
No, I think that remains to be seen. As I said, we are moving ahead at this meeting. It would be my expectation in 2 weeks with a rate increase, and we're going to make progress on agreeing on a plan at this meeting to shrink the balance sheet, and I'm confident we will. The question of when we implement that plan is not answered yet, so I don't think that's clear at this point. It's certainly something that we can't answer now.
Mr. Garcia referenced the President's State of the Union remarks last night. The President, when he talked about addressing inflation, said that we need to control cost. Did you hear him say that?
I did not. I was too busy getting ready for this hearing. I did not watch.
I won't tell the President.
I probably just
when the President said he wants to control cost, or that businesses should control cost to address inflation, would you have any idea what he's talking about?
I really can't comment.
Fair enough. In follow-up to my questions from Congresswoman Wagner, she asked you about cyber. I know pre-pandemic, pre-invasion, one thing that you talked about that kept you up at night was a cyber attack. If Russia were to retaliate against the United States in some form of a cyber attack, what degree of confidence do you have in our nation's banks to thwart a cyber attack from Russia?
What I can tell you is that everything that we can do to protect ourselves against cyber, we're doing it. We're doing it. The private, large financial institutions are doing it. They have been for some time. So it's very hard to say what's possible to happen, but we're certainly on high alert, and we will continue to be.
Thank you very much. The gentleman's time has expired. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Put it up, please. Thank you. Thank you very much, Chair Lady Waters, for your leadership in calling this hearing. Mr. Powell, first I want to say that at a time when we are still recovering economically from the COVID pandemic and we're facing challenges at home and now in Ukraine, I think and I feel deeply that the Fed should not be subjected to political stunts in the Senate with boycotts by the Republicans, and the Senate should consider the pending Fed board nominations as soon as possible. The Fed has an important job to do, and President Biden has put forward qualified nominees, and we need to get this done. So that's just my main point. With that said, as you and I have discussed in the past, the economic recovery has been has not been even, and we still have a ways to go to ensure our economy works for everyone. Just as one example, the black unemployment rate remains at nearly 7%, which is more than double the white unemployment rate. And later today, the Select Subcommittee on Corona Crisis is having a hearing where we will be looking at the depth of the pandemic's impacts on child care providers and workers and the results that has on our families and our economies. So I want to ask you about the monetary policy report the Fed released on Friday. The Fed notes that the labor force participation rate remains well below estimates of its longer run trend as a result of retirement and people out of the labor force and engaged in caregiving activities. From both a macro perspective and a micro perspective, what does this drop in labor force participation mean for the U.S. economy, and what does it mean for those workers who leave the workforce to care for their children or family members?
Well, having a lower labor force participation rate now, it's about a little more than a percentage point lower than it was. It reflects a lot of retirements. And, you know, what it means is that our labor force is smaller. That has consequences, including it's contributing to the labor shortage that we're seeing across industries all across the country. If we had a few more million people working, then we wouldn't be feeling that quite so much. It also means the potential output of the country is lower. Many of the people who are not in the labor force are retirees who have made a choice, but some of them are still people who want to come back but perhaps can't because of child care activities or fear of COVID or other factors. In any case, it's been the decline in labor force participation that we've seen has been much larger than that of other comparable nations. And it was not something we expected, and it's certainly something that's now contributing to wage inflation and actual inflation and to the labor shortage that we're currently seeing.
Thank you. It's been announced as a result of the Ukraine war and other disagreements that Russia and China are now moving to trade completely in their currency, no longer using the dollar. And Pakistan has flown in to meet with Russia. There's some talk that they may be part of it. What effect would that have on the U.S. economy if China and Russia no longer use the dollar in certain block trades around the world and with each other? What effect, if any, would it have on our economy?
Well, we do benefit from being the reserve currency for the main reserve currency for the world, and that really is because we have open capital accounts and the rule of law, and we have inflation, you know, over a long period of time under control, so that the dollar preserves its value. And so our markets are the most liquid, and it's the place where people want to be. Over time, the question is, if some want to move away from the dollar, what will be the effect on us? I don't think it's something you would feel right away. Over time, they would have to create an economic ecosystem whereby another currency becomes, you know, a better currency for them to use. You know, what we can do is we can make the dollar the most attractive currency by continuing to have the rule of law and open capital accounts and make it an attractive place for people to invest and to use in their businesses. There wouldn't be any short-term effect of that. Over time, though, you know, it would I suppose it would diminish our status as the reserve currency. It's also possible to have more than one large reserve currency, and there have been times when that was the case, and so it's not really clear.
Thank you. My time has expired. Thank you. I yield back, Madam Chair. Thank you.
Thank you. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair, and to continue several points that a number of my colleagues have raised. As Putin's aggression in Ukraine has continued to escalate, the U.S. and its allies have responded in a unified voice to condemn Russia and apply economic pressure. Chairman Powell, could you discuss the difficulty of predicting what the implications will be of locking Russia out of SWIFT?
So again, on sanctions, we're not the folks to ask. We don't design them. We don't implement them. So it would be really a question for the administration.
Let me word it this way. How sweeping do you foresee the ripple effects through the U.S. financial system? Is there an effect on us as those actions take place?
With big actions like this, there may well be unintended and unexpected effects, and hard to say what those might be. In the economic sphere, you're seeing, not directly to your question, but we're seeing concerns over palladium and neon and corn and wheat, shortages of those potentially, but so it would be difficult to say exactly what the effects could be over time. The United States, our financial institutions and our economy do not have large interactions with the Russian economy. It's a relatively small thing, and it's gotten smaller and smaller in recent years. So there wouldn't be, direct effects from these kind of things on the U.S. economy. It's hard to think what the second-order effects might be.
Thank you. You've answered my question. As Congresswoman Wagner touched on, the price of oil has continued to climb during the past year to its highest level in more than 7 years. And we now see international banks appropriately shunning Russian oil, even without energy sanctions. Could you describe the range of different scenarios the Fed projections paint in regard to this? And along with that, how do you see this potentially impacting the already rampant inflation issues?
Well, it obviously the price of oil depends on events that haven't occurred yet. It really depends on where this goes going forward. We have seen prices move up, including just in the last couple of days. And they moved up quite substantially since, if you go back 3 months before this incident kind of began, prices are up quite a bit. The effects are going to be passed through into gas prices, into lower economic activity, and into inflation, headline inflation. And, the larger the increase, the larger the effect. But the question then will become, that's a price level change. Is that going to lead to repeated inflation increases at that time? And that is not necessarily the case, and of course we would use our tools to make sure that it's not the case.
And of course, representing the constituency I do, which is both oil and gas and production agriculture, we take very careful note of what those actions will affect, how they will affect world crude oil prices, and of course, the Ukraine being a very historic major grain producer, my wheat people also are prepared to step up and match that. But it all underscores, I suppose, the increase in energy production in the United States and supporting policies that will not penalize or drive capital away from domestic oil and gas production. That's more of an editorial on my part, Mr. Chairman, but I note that we stand ready in this country to replace resources that may not be available or affordable for the rest of the world, and we just need a little incentive and encouragement from this side of the room to utilize those things. So my last question in the time I have remaining, the economy is currently operating in what I think we'd all describe as, at the very least, massive economic uncertainty. And when you deal with this 40-year inflation and the supply chain issues and the COVID-related issues, hopefully as we're in that final stage, can you elaborate on how critical it is for the health of the economic system to be reliable and to maintain liquid markets so we can navigate through all of whatever lies ahead of us?
Yes, so I would say our markets have been functioning well. There's a great deal of liquidity out there. We have now, between our swap lines and our repo facility for other foreign central banks and our standing repo facility in the Treasury market, we have institutionalized liquidity provision. And I think just the knowledge that that is there will help support good market function, which, despite all this volatility, we still have.
Thank you, Mr. Chairman. I yield back, Madam Chair.
Thank you. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman Water. Chairman Powell, thank you for being here today. Given what you said about the upcoming meeting in March and the illegal invasion of Ukraine, how is the Fed coordinating with other central banks around the world and accounting for their actions when considering adjustment to interest rate policy here at home?
So we're in ongoing contact, it's fair to say, with our major central bank colleagues, and actually we have a meeting of all of them on Monday morning at 7, a virtual meeting at 7 a.m. on Monday. So it's something that we do regularly. That said, we conduct monetary policy to achieve domestic objectives, specifically here in the United States, maximum employment and price stability, and that's what we use our tools for. But it's of course the foreign events are very much top of mind right now, and it's enormously helpful to understand the perspectives, particularly of the Europeans who are so much closer physically to what's going on. So that's an important channel for us.
Thank you. And Chair Powell, last week the Fed published its 2022 Small Business Credit Survey. Among other things, the report found that small business applicants that used online lenders for their financing needs reported more challenges with their lenders than did applicants at other sources. The top challenges faced by borrowers from online lenders were high interest rates and unfavorable repayment terms. Can you explain the report's finding and what it could mean for small businesses that utilize online lenders to satisfy their financing needs?
So if I recall that survey, it did raise some interesting questions, and our people looked at it and actually saw differences in data gathering. So it's not clear that the data in the two surveys was comparable, but I do think it raises interesting questions, and we'll come back to your office on that.
And it might raise interesting question where we, through legislation, could provide some relief and regulations so that small businesses are not shortchanged when it comes to the most important element for any small business, access to capital, affordable capital. Chair Powell, during public remarks last month, Acting Comptroller of the Currency, Sue, stated that in the not too distant future, the OCC, Fed, and the FDIC will issue a joint notice of proposed rulemaking to update the Community Reinvestment Act. Does the Fed also believe a joint NPR is possible, and when do you expect it to be released?
Yes, we do. We think that will be ideal, and we're working very closely with the OCC and the FDIC and to come up with a consensus notice of proposed rulemaking reflecting all of the comments that we got on our advance notice of proposed rulemaking. I think the timing is soon. I wouldn't want to put a specific date, but I know that we're going back and forth, and it feels like we're getting very close.
Right, thank you. And Chair Powell, a note published by a Credit Suisse strategist over the weekend warns that a decision to exclude certain Russian banks from the SWIFT system, which I support, could result in missed payments and giant overdraft with significant consequences for money markets, thereby forcing the Fed and other central banks to intervene to enhance liquidity to offset missed payments. Do you see this scenario as likely?
No, I don't see that as likely. Of course, we always appreciate looking at different risk scenarios. But again, given the relatively modest exposure that our banks have directly to Russia, and given the existing tools we have to provide liquidity, I don't see that as a likely outcome.
Okay, thank you. I yield back.
Thank you. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. Chairman Powell, thank you for taking time to not only join us today, but your insight into monetary policy. The monetary policy report of February 25th, seemingly still hot off the press, brings about, I think, a good review of the Fed's analysis of where we are. And I know there's that temptation by members of Congress to hold you accountable for things which are not within your purview, but on page 3, you talk about special topics. Page 3 of your February 25th, 2022 monetary report. Special topics, low labor supply. Next, it goes to several other issues, then supply bottlenecks. As a member of Congress from Texas, both of these are highlighted to me on a daily basis as I receive feedback. This is inflationary also. We have taken a bit of time with you to probe with you your ideas that I think you have professionally handled on behalf of yourself and the Fed, the issues related to energy. But the bottom line is we can't get people back at work. We find that turns into a low labor supply, and then we've got bottlenecks. These are all hand in hand, glove in glove together, in my opinion. I took a few minutes just now to look at the labor unions and schools, teachers unions. But let's move to the federal government. Where is the federal government on their employees coming back to work now by OPM?
I don't know. We're an independent agency. I'll tell you where we are, we're in the middle of that process. Probably closer to the beginning than the middle.
I know you are, but you see, if they don't come to work, then others don't come to work. So I think your point and my point is well made. I believe that what we need is your robustness, not just your acumen in these issues, and your robustness within the administration to actually let them know that for this report, monetary policy, to be correct, that you believe inflation is a short-term, meaningful hindrance on our economy. They're going to have to make, meaning the White House, policy. They're going to have to understand what caused this. And I think that this administration, I think the Democratic Party, I think this Congress has made friends with inflation to encourage it. And that if your prognostication is going to come forth that we end this inflation, we're going to have serious changes. Because right now in Texas, which has been relatively open, I don't see relief on the horizon. And I think that this administration, this Congress, has a lot to do with it. So without chastising you, I meant to help you. I would like for your voice in this administration and within halls of Congress, perhaps doors that are shut, for them to understand that they have actually made friends with and are continuing inflation, whether it be with teachers unions or whether it be with OPM. And we've got to get serious about getting people back to work, because as you tap down the amount of money that is put in the economy, as that moves, it's going to have to correspondingly have people that come to work, that pay taxes, that move the economy, GDP as a term we used earlier today. It's shifting this big, massive task. So you've almost got a whole 30 seconds left. But I'd like you, without defending yourself, to say to you, I'd like for your voice of reason, of prosperity, of future to come true as you would like. Did I ask you a question? Okay, I'm going to support you. I'm for you. How can we help you?
I do think honestly, we have the tools and we have to use them we will use them to get inflation under control. But to the extent we get help from the supply side, it'll make that job so much easier. It's about labor force supply. It's really about supply constraints and shortages and that kind of thing. It's also about exogenous events like a war, which will drive up the price of oil and gas, and that'll get into prices, certainly, and we'll make sure that it doesn't provoke a cycle of inflation.
This is what happens when you have to rely on other people for your food, cheese, and energy. Thank you very much, Mr. Chairman.
Thank you, Mr. Sessions. You can help Mr. Powell, by asking your friends on the Senate side to confirm his appointment. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes.
Chairman Powell, how are you?
Fine, thank you. How are you, Mr. Scott?
I want to sound the alarm here this morning. And I want you to listen to me, and I want the nation to, because I'm the chairman of our House Agriculture Committee. And I'm very worried about this turmoil over in Ukraine and Russia's violent, illegal, and criminal action that they're taking, and the impact that this has on global trade, and most importantly, our own food security. We could very well be on the verge of a hunger crisis all over this world. I want to share with you some research and the nation so we can understand what this Ukraine-Russia situation is causing. Today, Russia alone is producing more than 2/3 of the 20 million metric tons of fertilizer used to grow corn and wheat around the world. One country producing 66% of the fertilizer that is needed. And when you combine Ukraine and Russia, also, these are the two largest exporters of wheat, corn, and barley, producing 1/4 of the world's wheat in these two countries, making this impact a crisis of soaring magnitude when you have this much, and these two countries are warring each other. So I want to sound the alarm on this. I want to ask you this question. I want to ask you, Chairman Powell, the disruptions and rising prices from these commodities will destabilize global food markets and threaten our food stability and social stability. So my question to you, Mr. Chairman Powell, to what extent could these developments create a financial stability risk here at home and abroad? And what must we do? We can go without a lot of things in this world, but the one thing we cannot go without is food. And when you have this much power on our food security for the world in the hands of these two countries warring at each other at this time, what can you do about it?
Sir, I think your point is very well taken, and I think it's shipping, it's corn, it's wheat, as you pointed out, it's fertilizer, and we see that getting into food prices and into the food supply just in these early days after the sanctions have been put in place in the war, less than 2 weeks old now. The Fed doesn't really have the tools to address this. This is really a matter for Congress and the administration, I think. But you're right to call attention to it, and I do think that this is understood and understood that that help will be needed here.
Well, I just want to say that we cannot allow the world to get into this desperate situation. So I'm giving this as sort of a Paul Revere moment here. I'm not saying the British are coming, but I'm saying the Russians are already at the door, and they could cause worldwide hunger. And I hope that free nations around the world can come together and realize that this is not just Ukraine's fight. It's our fight. And we have got to win this fight. And hopefully we can get more of our nations to come together and end this situation in Ukraine and Russia before it causes truly a worldwide war.
Thank you very much. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Chair Powell, when your former deputy, Mr. Quarles, came before the committee last May, I pointed out to him that just a week before the April inflation rate had been reported at 4.2%, the highest since 2009. The rate in March 2021 had been only 2.6%. I asked him if we were paying the price for monetizing a huge federal debt, what the late Dr. Friedman and former Chair Bernanke both called helicopter money. Mr. Quarles told me that he didn't believe the Federal Reserve was monetizing the debt. Mr. Chair, looking back a year, does the Fed continue to deny that it has been monetizing the debt? And do you believe that you should have acted before now to rein in the inflation rather than let it now exceed 7.5%, the highest rate since 1992?
So I think by monetizing the debt, what that means is for the central bank to purchase the debt with the intention of holding it. And that's not the intention of here. You know, we're about to start shrinking the balance sheet, and we will return the balance sheet to, you know, a size relative to our economy that it was before. So also that is not at all our intention. We purchase longer-term securities in order to drive down longer-term interest rates to support economic activity. I'd also say that that's not really what we think of as the source of inflation. Admitting that inflation, proclaiming that inflation is far too high and that we are committed to using our tools to get it back down, it's really about very, very high demand, particularly in the goods sector, related to a spending shift that happened in the pandemic, and supply constraints that we didn't foresee. International supply chains, labor constraints, low labor force participation, right across the economy. It's a very different kind of inflation story than we've had in the past, but it's one that we have to deal with, and we will deal with it.
Chair Powell, when you appeared before this committee in March of last year, and I asked you to clarify the purpose of the Federal Reserve collecting data and employing stress tests related to climate change, you assured us that the Federal Reserve would be collecting the information to help financial institutions learn about climate risk and wouldn't be using the information for regulatory purposes. In recent weeks, considerable controversy has emerged in the confirmation process to fill 4 vacant seats on the Federal Reserve Board. One of the nominees has a record of advocating for aggressive Federal Reserve regulation related to climate change, including actions that would regulate capital allocation away from fossil fuels. I won't ask you to comment on the confirmation process, but can you continue to assure us that the climate data and stress test proposed by the Federal Reserve won't be used for regulatory purposes and driving investment away from traditional energy sources here?
We call them climate stress scenarios, and we haven't, you know, we're actually just building the capability to do this. And the idea is not to use them the way that we use the traditional stress tests to set capital levels, in effect. The idea is more to allow financial institutions and also regulators to understand better, you know, the extent to which and the ways in which climate financial risks has any implications for the banks. That's the purpose of it. I'll add, though, that it is not our job to tell, we don't think, to tell banks which legal companies they can and can't lend to, and I don't see that as an appropriate role for us.
I'm really glad to hear that. So that's an absolute, unequivocal, guaranteed answer that the data will not be used for regulatory purposes in any way whatsoever.
I can just say that first of all, we're not even doing the tests yet, or scenarios yet. But certainly that's not going to be their construct. The construct will be what I said, which is to help us understand better, not to set capital or otherwise put further regulatory requirements on. Okay.
Thank you so very much. I deeply, deeply appreciate that, and I yield back. Thank you.
Thank you very much. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Good morning, Mr. Powell. How are you?
Fine, how are you?
I'm good. And I just want to thank you. You've been getting picked on inflation, but I'd like to start with chart 1 of your book. I always ask about your charts because I love them. And chart 1 shows a tremendous growth in employment, as does chart 2 shows a tremendous drop in unemployment, the converse of it. And it's like dropped from about 14% to 4%. Do you think that the Fed's monetary policy helped in reducing the unemployment rate?
Yes, for sure.
Okay. And, 2 years ago, we were going into a pandemic, and you and I had a conversation about the potential for a worldwide recession of a magnitude we'd never seen. Did we hit that? Did we get that recession?
No, we didn't.
And you may recall, I'm a bankruptcy lawyer. That's what so I look at things kind of with the pessimist eye. I expected many, many bankruptcies. Did we have those? Did we have the bankruptcies that we thought we might get?
We sure didn't.
Okay. Do you have any idea how much the gross domestic product has grown in the last year?
I want to say 5-point-something%.
Well, it's actually more than that. And one of your charts has that. I think it's on page 23, chart 14. It went from 2020 to now. It went from less than $17.5 trillion up to $20 trillion. So it's substantial, about 15%. Now, I don't think it's that much, but it's substantial. Did we expect that when we went into COVID?
You mean since the trough? Yeah. No,
yeah.
I was just giving you the last year. So, as you know, we were looking at some really bad scenarios and hoping they wouldn't happen in the first half of 2020.
Now, the Fed took some pretty dramatic actions, as did central banks around the world, did it not?
Yes.
Okay. And the Congress, led by the Democrats, took some pretty substantial and dramatic steps, including the CARES Act, the American Rescue Plan, the infrastructure bill, to build a better America and to help us get out of what looked like it could be a tremendous recession. Now, I could ask you, did it not? But I'm not going to lead you in that one. But what I do want to talk about is the fact that despite the one flaw that Republicans can find, which is inflation, we have lower unemployment, a bigger economy. Do you know how many other countries have higher inflation around the world than America? 64, according to Trade Economics Inflation of country by country. 64. This is a worldwide phenomenon, is it not?
Yes, it is.
Okay. So I want you to take a look at a couple more of your charts, because I think these are probably the most important. And they are the median wage growth found in chart C on page 12, and the change in the price index for personal consumption on the next page, found on page 13, diagram 8. According to your chart on page 12, the bottom quarter of wage earners have had their wages increase by almost 9%. Do you see that?
Yes.
And the bottom, the next quarter, by 6.5%, 7%. Do you see that?
Yes, I do.
Okay, and then you look over to the next page, and we're running, I think you said it, about 5.5% inflation. So wage earners in the bottom half are making more money than they are potentially, if I do the math, they're making anywhere 8-9% against a 5% increase in cost. Now, it's not apples to apples, but wages are going up, are they not?
So wages at the bottom, in the bottom quartile, have gone up in real terms. I do not think that's true for the second, third, and fourth quartiles, but it is true for the bottom quartile that their wages, nominal wages, have gone up higher, more than inflation.
Okay. So last question. When you and I spoke at the beginning of this year, and my time has expired, I'll ask it to you later on. And I thank you for your service, sir. I thank you for keeping us out of a recession. I think we built a better America by staying out of the recession. I yield back.
Thank you so much. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you, Chairman Powell, for coming here. And I also appreciate your book and the work. And frankly, just yet again want to highlight the really heroic work that the Federal Reserve did to create stable markets, particularly in March and April of 2020. Since then, of course, there have been a lot of economic distortions, one of which is the ongoing inability of the Federal Reserve to stabilize its own balance sheet, which is now over $9 trillion. I appreciate Mr. Perlmutter highlighting some of the good news. And frankly, I'm positive that he has previously operated a lemonade stand because you can always turn something good out of the lemons. So there's not that there's no good news, but the concern is that in the long term, this has come at the expense of sound money. And so just over a year ago, I talked to you about sound money, and as the U.S. dollar represents sound money, because many of us anticipated that inflation was not transitory and that the quantity theory of money might have some impact on inflation. So in light of the fact that we have seen substantial change in the rate of inflation now versus what was showing up then but was anticipated, do you still think that the U.S. dollar is sound money? And either way, what are the threats to the U.S. dollar as sound money?
The U.S. dollar is sound money, yes. The threats to the U.S. dollar as the reserve currency really, in the near term, are to displace the U.S. dollar as the reserve currency, if that's your question. You would need to be a very attractive place to hold large amounts of reserves.
It's really different than that because we are probably still going to be the reserve currency since the world grades on a curve, and frankly, the planet's never had this much debt since World War II. So all of the countries around the world did similar things. The discipline of the Bretton Woods era was gold. I don't know that there's magic just in gold, but there is magic in discipline. So if you look at sound money being defined by a stable store of value, an efficient means of exchange, and a trusted record of an account, you've at least taken some dings on store of value. And so as you've seen people decide to filter transactions and develop technology and regulatory frameworks that are intended to be able to filter transactions, it's not as trusted or efficient as a means of exchange or a record of account. And so those kinds of things, not so much do we do okay on the curve, but is it truly sound?
I'm not sure I followed the last part, but I do think that, look, inflation is indisputably too high. We are using our tools to bring inflation back down to levels of price stability, and we will accomplish that task. Longer term, the U.S. dollar is easily the best currency, and it's because of what I just said. It's also because of the rule of law, and the fact that we're the incumbent, and we as long as we observe the rule of law and keep the dollar relatively, keep inflation low and predictable, that will remain the reserve currency.
Yeah, okay. So thank you, Chairman. And look, historically, there have been multiple reserve currencies, and generally, when something loses its status as a reserve currency, it's not just because of other things that unfold, but it's because the value is debased. And we can come up with fancy words like modern monetary theory or quantitative easing or, similar to quantitative easing, but not really the same. When the Federal Reserve's balance sheet's growing, in a way it represents the Fed as the lender of last resort. We're not constrained by the taxes we collect. We're not even constrained by the amount of money the world will lend us. We're constrained only by the will of Congress to not spend more. And what are you going to do? Not cover the spending, the prolific spending by Congress. So moving on, just talking about, the Fed's role, of course, stable prices is really one component. The other is full employment. And I wonder if you think, in light of Mr. Perlmutter's reference to Chart 2, if Chart 4, which is the labor force participation rate, trends the right way, and as you link to the next thing as a regulator, there's a lot of pressure for you to do ESG. What can the Fed do, and what does Congress need to do to strike those balances?
With relative to ESG?
And full employment.
Well, full employment, I think most members of the FOMC now think we are at labor market conditions that are consistent with maximum employment.
With 60% labor force participation? 62?
I mean, the maximum employment can never be higher than the level that's consistent with price stability.
The gentleman's time has expired.
I think we're at that level.
Thank you.
At least.
The gentleman from Illinois, Mr. Foster, who is also the chair of the task force on artificial intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. And I'd like to add to Representative Perlmutter's list of your triumphs the record level of small business formation. And so I think that when you try to preserve the very strong economic recovery, I realize you have a dual mandate, but keep an eye on that one too. It's one of the most important successes we don't talk about enough. Do you remember the misery index?
I do.
Yeah, and so that when unemployment drops from 14% to 4%, so drop by about 10%, and then the inflation goes from 2% to 7%, so up by 5%. Does that mean the misery index is increased or decreased?
It would be decreased.
So thank you for that. Now you actually mentioned repeatedly that the inflation problem was largely one of goods. And not so much one of demand and also of labor shortage. And so can you make any rough estimate of what fraction of the inflation we're seeing was due to sort of those three effects?
So I should be clear. Inflation is also too high in the service sector. I wouldn't want to oversell that. But the real big change has been in goods, which had negative inflation or close to zero inflation for 25 years. I don't have off the top of my head the ability to just tell you what the contribution of that is, but it's big, and it's a significant part of it. It's a lot of it also is energy, which is not
obviously a worldwide problem.
Yeah,
and so that this is if you could get back something a little more quantitative from your staff on that, I'd just be really interested in knowing your estimate. Now, in terms of the labor shortage, back in the days when we had a different Senate, they passed comprehensive immigration reform that was then, of course, blocked by Republicans. And many studies at the time indicated it would be a huge positive for our economy to pass comprehensive immigration reform. And that was at a time which didn't have an extraordinarily tight labor market. Is there anything you can think of that would invalidate those studies that showed that comprehensive immigration reform in both the low skill and the high skill sectors would be a huge plus if it was passed?
If I can answer that this way, if you look back at the trend, let's say 5 years ago in that range of immigration, legal immigration, people coming in, and look where we are now. We're now several million people, many of whom would be in the workforce short of that. So lower immigration is definitely part of the story of the labor shortage. But that's what I would say.
So is there anything quantitative you can say about the time scale for unwinding the balance sheet? Do you think of this in terms of a fixed time scale that we want to go back to normal in the next 2 years, 3 years, or do you say we're going to take it down by 1% 1% a month, or are you anticipate some sort of feedback loop where we look at the taper tantrums or the equivalent and sort of adjust it as you go?
So the way we did it last time is we set a cap on the amount that will run off, and anything above that gets reinvested for both MBS, mortgage-backed securities, and for treasuries. We haven't had that discussion at the committee. We will have it in 2 weeks. But I guess it takes. It turns out that the level of the cap doesn't really matter that much for how long it takes. Something in the range of 3 years to get back to where you're trying to get to. And the way we define that, what is the end? We look at the size of the economy, the size of the banking system, and we ask, what's the level of reserves that we'll need at that point? And so we set a course for that place, and then as we start to get close to it, we might slow down a little bit, like as though it were an airplane, and that's the way it will work. But I think something in the range of 3 years to get back to what the balance sheet needs to be, which is basically reflective of the public's demand for our liabilities plus a buffer, and what we call ample reserves.
Yeah. Do you have an estimate for how many hours of your life have been spent attempting to explain the difference between quantitative easing and monetizing the debt to members of Congress?
No, sir.
Okay. All right. Now, one of the most valuable functions of the Fed is to provide the emergency assistance to the financial systems of the free world. And you mentioned that you stood ready. Are there specific things you're worried about in Eastern Europe where the economies are more tightly tied to Russia, where you may really have to step in and get involved? Any specific worries?
What we're watching is sort of the global markets and the dollar funding market, and we're seeing markets that are functioning, and of course we have tools and we have things in place to deal with stresses should they emerge. That's really what we're doing, and as I mentioned, markets are functioning, so we haven't had to deploy any of those tools.
Thank you, and my time's up. I yield back.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Good to see you again. We're in the middle right here of a really disastrous situation with Ukraine, and part of the approach to corralling the Russian advance there is on the financial side. And it would appear to me that we probably didn't do this as quickly as we should have. Didn't look to me like we had a plan. If we really wanted to get involved financially, we should have been sitting here saying when they move the 1st battalion or regiment or wherever amount of troops you want to talk about on the border, we should have said something, well, okay, if you move another one there, we're going to start doing things to you. And we didn't do that until they started to invade, and now all of a sudden we're playing catch-up. So that begs the question, we know that China is watching all of these actions very, very carefully. They're looking at what Russia does, how we react, what we do, how the rest of the world reacts, what they do. So to me, we need to be sitting here as a country, as the Fed, as congressional individuals saying we need to be ready for the Chinese when they invade Taiwan, because I see no reason why they will not do that shortly. So if we don't prepare for that, shame on us. So my question to you is, are you beginning to think about what kind of actions you would take or support or suggest to the administration should China take over Taiwan or attempt to do this? Because this is going to be a completely different scenario because of the size of China, the size of the military, the size of Taiwan versus getting into Eastern Europe. So that's kind of a large question, but can you like to jump into it?
Sure. So, those questions are really questions that are dealt with at the National Security Council and the Defense Department and the intelligence agencies and the Treasury Department. We're interested students of all that, and we have our technical expertise that we can contribute, but honestly, we're not.
Mr. Chairman, now, I listened to you very carefully a while ago, and you made the comment that you're looking at making policy for anticipated situations in the coming months with with regards to a number of things. What happens with the economy, what happens with inflation. And so if you're not doing that, I understand you may not want to tell me today because that would be helping the Chinese who are probably watching this right now. I understand that. But just a sort of wink and nod to say, yeah, we're looking at that would certainly be nice because it will give us a level of comfort to know that we're not going to be, behind the 8 ball again.
Well, I mean, as I also mentioned, we do model alternative scenarios of various kinds. And, we, in fact, with every Teal book, which is our document that we use at the FOMC, we run half a dozen of them in great detail, and people study those, and it helps them think about alternatives. So I'll just leave it at that, if I could.
Okay, thank you. I'll let you off the hook on that one. With regards to inflation, we've talked about it significantly here today, and I think sometimes that you're giving way too much credit for it and giving way too much criticism for it. I think that there are a lot of things that are outside your control that happen that basically affect inflation that you have to react to. You don't make monetary policy from the administration side. You don't make legislative policy from the legislative side, and yet you have to react to all those things. So I had an economist, I'm the ranking on small business, I had economists come in to talk to our committee the other day. And I asked him to break down the different causes of inflation. And I said, well, let me identify at least what I think are 4 significant causes. One is money supply, the amount of money that's pumped in, either through Fed actions or through our actions as Congress, regulations, supply chain / workforce situations, and energy. And he broke it down like this, and he had some charts, and he started going off, and I said, just give me the percentages. And so he said, roughly 40% due to money supply, the money that goes in as a result of Fed actions or congressional actions, 20% regulations, 20% supply chain, and 20% energy. So if you look at that, I know Mr. Foster, while ago, was looking for some answers, so hopefully I've helped him with this question. If you look at that, basically you don't have a lot of control over regulations. You don't have a lot of control over supply chain and no control over energy policy. And money supply, if the Congress gets involved and passes these massive bills and throws a lot of money in there, you haven't control of that either. So the amount of control over this is probably in the neighborhood of 20 to 40% at best. So, my concern is that when you say that you're trying to help things with inflation, it really goes back to the administration and to us as Congress. The administration, first thing they did was stop the pipeline, stop oil drilling, and prices went up. And so that right there is 20%. So it's important, I think, that we understand that. I'd like for you to comment, if you would, just for a second. I'm running out of time. If you'd like to comment.
Sure. Interesting breakdown. We can continue this discussion. We would have a little different assessment. I would just say, though, we welcome, this is a lot about supply side issues, and we welcome any help we can get on that, and we're looking for help from improved supply side.
Okay.
Thank you very much. The gentleman's time has expired. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Douglas Holtz.
Thank you, Madam Chair, and Chairman Powell. Welcome to the committee. Before I ask my question or statement, they say one of the benefits of inflation is that you can live in a more expensive neighborhood without moving. And so I thought that was very interesting.
That's a good one.
Statement I had seen, and I thought I would bring it to your attention. According to the recent analysis of branch closures by the National Community Reinvestment Coalition between 2017 and 2021, banks have closed as many as 7,000 branches across this country, 1/3 of which was in low-income and moderate-income communities, neighborhoods of color. To what extent is the Fed considering these banks as in contemplating which reform to implement and strengthen the Community Reinvestment Act and the importance that banks' branches play for nearby communities?
So I do think that's a focus of the CRA and also of the focus that we want to strengthen in our proposal that's out for comment. Actually, it's now. We've had the comments, and we're getting ready to put a notice of proposed rulemaking out. But we do understand the importance of presence in the community and service to the community. And those things do go into our CRA assessments.
Okay. Mr. Powell, according to the latest forecast from Goldman Sachs and the Federal Reserve, which raised interest rate more than expected this year due to high inflation and labor market approaching full employment, can you speak more on this? Should we expect the Fed to raise interest rate at all several remaining pilot meeting this year? And should we expect the Fed's main rates to be by the end of this year?
So yes, so the inflation is running well above our target. The labor market is extremely tight. The economy is growing strongly, and our policy rate, we do expect to move our policy rate up in a series of rate increases this year, away from the very low setting that we put into place during the acute phase of the pandemic, and to a more appropriate level, given the fast recovery and the strong recovery that the economy has had, given the fact that inflation is running so far above our target. We do expect that will be appropriate. We've communicated that transparently and clearly, and markets have accepted it, and it is our plan to return to price stability while also supporting a continued expansion.
Okay, and I want to make sure that I understood the statement that was made earlier, and I know you had the opportunity to observe other inflations that we've had. With wages going up, as they say, and the bottom half are making more in earning, do you consider that we are in a better situation to deal with inflation that we have now compared to inflation in the past?
I think that this inflation is substantially higher than anything we've seen since I was in college, 50 years ago. So this is strong, high inflation, and it's very important that we get on top of it, and that's exactly what we're going to do. I would say this: the labor market is extremely strong. So from that standpoint, I do think we're in a good place from the standpoint of trying to get inflation under control. Workers are still going to be getting good jobs and pay increases for some time, so the economy is strong, and that means the economy can take the rate increases that we're going to be making. Ultimately, we need to get demand and supply back in alignment so that we can get inflation back to a more appropriate level.
Okay, thank you, sir. And with that, I yield back, Madam Chair.
The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair, and Chair Powell. I appreciate this opportunity. I'm actually going to pick up on what my colleague from Florida was just talking about and add that to what my colleague from Missouri next to me here was talking about. And I'm going to, you may have said that the 40-20-20-20 ratio that came from Douglas Holtz-Aiken, breaking that down, about 40% of inflation being tied to monetary policy and spending, 20% to regs, 20% energy policy, 20% supply chain. You might disagree with that, is what you had said, but do you believe that spending has contributed to the situation of high inflation that we are in?
Okay, thank you.
So I may have misunderstood what your colleague said.
Madam Chair, I ask that you suspend. I think Mr. Lawson has his microphone on yet, and we're getting a little crosstalk. So if we can maybe add a few seconds back here.
Okay. Is the gentleman muted now?
No, clearly is not.
I think you can resume.
Okay, I'm just like to would ask that you have a light gavel at the end of my time here. I think we were having a little crosstalk as we go back on that.
So I may have misunderstood. I thought that the 40% was money supply, but you made it sound more like a monetary policy. And so I would look. I mean, look, we can discuss those numbers, but that makes more sense to me.
Point being, has spending contributed to inflation?
Yes, I think a number of factors have,
Okay.
including
All right.
policy.
And I would agree with that. And, frankly, many of us have sort of warned or talked about this situation. We have record debt right now, previously, without conflict. Now, war and rumors of war that we hope aren't going to happen may even increase that debt. And I'm afraid that our spending habits are putting you and all policy decision makers in an even tighter box. Look, we all know that inflation is real. It's hitting, whether it's gas, $3.79 versus $2.74 a year ago, groceries, you name it, housing. And when you were here in July, I talked about the housing situation. My family's in construction and what that means. And we can't just magically wave a wand and say, oh, we're going to lower prices. That just simply isn't realistic. But what I heard last night is that the president is acknowledging people are living paycheck to paycheck, and he understands that. Yet the message I keep hearing from the president and my friends on the other side of the aisle is we need to spend even more. And I'm concerned that is going to put us, again, into an even tighter box than we currently are. If you care to touch on that before I move on.
I should stay away from fiscal policy if you don't.
Well, and look, I'm not asking whether you support a particular bill or not. Theoretically, we're your classroom. America's your classroom as they're watching this right now. Spending is a contributing factor to inflation, correct?
It is, but it's not really our job and not ours to comment on. We do have a role here, and we need to do it.
Fully understand that. I just the facts. That's all right. So I'm going to move on to another issue, which is rules-based approach to monetary policy. In the 114th Congress, I think it was in 2015, I introduced the FORM Act, which would lay out a rules-based monetary policy. And I know in your testimony today indicated that a rate increase is expected, and you confirmed that with the ranking member. So what I'm curious, though, is since 2017, the Fed's monetary policy report included a section on monetary policy rules. And you've been very clear, and now Secretary Yellen has been clear that a lot of rules are modeled and looked at. The only exception to this was 2020, the first year of the pandemic, and maybe more surprisingly, the report that was just released this month. For example, in 2017, monetary policy rules section of the report stated, quote, monetary policymakers consider a wide range of information on current economic conditions. It's not included in this report. Can you shed some light on why it was omitted this year?
I honestly didn't know if that was the case, or if someone talked to me about this before the thing was printed and sent up here. I don't remember it. That's also a real possibility given the number of things I have on my mind right now. But as you say, we didn't have it in July of 20. We'll have it in the next one. I don't think there was no big thought, as far as I know, going into that. It's just sometimes we include it, sometimes we don't. I will say that I think thinking about policy through rules is something that I learned a lot about monetary policy doing that. When you're actually implementing policy, no committee has ever really used policy rules as a way of setting policy. But they use them to inform your thinking.
Yes, and I guess my idea with the FORM Act was to then inform the market, and that includes us as citizens as well. And I'd like this committee to re-examine that. So I appreciate the indulgence, Madam Chair, as we had that crosstalk at the beginning, and I yield back.
Thank you. The gentleman from Illinois, Mr. Caston, who is also the Vice Chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Pro Tem Powell. I'm always struck that there's a real risk of hubris for those of us in our line of work, at least up here. If we get to write laws, sometimes we conclude that means we can write the laws of physics as well, which is dangerous. And I am troubled by some of the questioning of my colleagues and, some of the debates around confirmation of your colleagues around climate change. The IPCC report that came out last week said Climate change effects are outpacing our ability to adapt. We're seeing communities that sort of simultaneously have droughts, floods, and fires, and money is moving in surprising ways. We've seen, personally, I've seen stories just in the last month of one coastal community where the roads are being washed out that haven't yet paid off the bonds that were used to pay for the road, and they don't know how to reconnect those communities. Another community on the coast where the mayor is sitting there realizing that one neighborhood he can afford to build a seawall, and in another neighborhood it's cheaper to relocate people, and dealing with the political fallout of that decision. We have massive political risks that are coming, and we know they are coming because the laws of physics do not care how we vote. And I'm concerned by your response to Mr. Posey when you said that I think you said we've not even done the scenarios yet, excuse me, on the climate change. And I understand these are complicated, but if those scenarios haven't been done, I want to start, if we don't deal with the financial fallout, the political fallout is going to be far worse. And so I just want to start with a very specific question. NOAA and NASA came out with a report, I think last week or 2 weeks ago, saying that Florida is looking at 12 inches of sea level rise in the next 10 to 20 years and 18 inches by 2050. That means that there are whole communities in Florida where there's going to be complete property loss before a 30-year mortgage is repaid that was issued today. Are Fannie and Freddie changing their lending standards in response to those risks in those communities in Florida and elsewhere that are now within 30 years of being unable to repay those notes?
I don't know.
I asked the question there because in the CFTC report, Managing Climate Risk in the Financial Sector, came out about 2 years ago. They noted that the higher an area risk for coastal flooding, the more likely the commercial banks are to be offloading their risks onto Fannie and Freddie. And so if the sophisticated players in the system are seeing this risk and we are at a federal level are backstopping, how are we isolating our federal balance sheet from that risk exposure?
I think that's a very likely outcome, actually. I think as private lenders will move away from that, and will the government force people to move away from the coast, or will they wind up government, that's us, wind up picking up the tab? More likely the latter, it seems to me.
So moving away from the offloading risk onto the taxpayer, back when I was in the energy industry, one of the tells that we had that we knew there was a downturn coming in energy markets was when the big banks started creating Special Opportunity Fund 5. And we all knew that was code for taking your Dodd-Frank compliance debt capital, moving it into an equity pool, and selling it off to the least sophisticated people in the equity space. We all know, anybody who spent time in the banking industry has seen that game. To what degree does the Fed or the Treasury have the ability to monitor where the sophisticated folks who are seeing this coming are shifting the risk off to the less sophisticated folks in the private sector?
There's a lot of thinking going on about this. I'd have to think about that. But there's a lot of thinking about what will happen over longer periods of time in coastal areas and things like that. I can look into that for you.
Well, and it's not just coastal, right? I mean, it's California fire risk. Do you rebuild that house where the fire is, and who's holding the paper, if it burns the second time before it's paid off? It's drought risk in communities, running away, the capital movements. And to be clear, we are going to create so much wealth in the transition to a clean economy that I think we can find more winners than losers if we're smart about this. But there's this huge capital flight, and the nervousness I get is, as I said, partly that we're shifting risk onto the public sector, and partly that if we don't have a real good understanding of what the capital structure looks like in these communities, we're not seeing it. As you know, Senator Schatz and I have introduced this bill to push and encourage you and your colleagues to do these climate, whatever we're talking about, scenario analyses. But we know the sophisticated people are going to offload the risk. And as the IPCC report said, the effects are outpacing our ability to adapt, and we need to get ahead of this much quicker.
I would want you to know we are working on the scenarios. It's just it's an active effort on our part.
Well, let us know how we can help you. Make sure you have the resources to move a lot quicker. Thank you, and I yield back.
Thanks.
Thank you. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Good to see you again, and thank you for your testimony today. I appreciate your testimony that overspending has contributed to the inflation crisis we're facing right now, but I also appreciate your your humility with respect to the Fed failing to meet its price stability mandate, and the fact that you admit that inflation is primarily a monetary policy phenomenon. So I want to focus on monetary policy in my questioning. And I know you understand that this has human costs. I want to share a couple of anecdotes from my district. A painter, Gerald Holland from Nicholasville, Kentucky, says a gallon of paint costs $10 more today than a year ago. The Suffaletta family from Georgetown, Kentucky, they've been in the retail home furnishing business since the late 1940s. In a conversation last week, they informed me that in the last year, the cost of goods from their manufacturers have increased 30 to 40%, and they're still receiving price increase letters every week. And like most small businesses, their cost of labor and overhead have gone up over 25%. So now they are having to determine how to operate without passing those costs on to the end consumer and still have some profits left at the end of the year. I could share dozens, as many of my colleagues could share dozens of these kinds of stories, including from constituents on fixed incomes who cannot afford the dramatic reduction in their purchasing power. Before November 2021, Chairman Powell, when you declared it was time to retire the word transitory in relation to inflation, my colleagues and I repeatedly, in these hearings last year, after the $2 trillion spending bill, we cautioned you that inflation wasn't transitory, that we were hearing from our constituents, individuals and small businesses, that inflation was hitting them hard and was sticky. But the FOMC kept up with the unconventional monetary policy. And even after you retired the word transitory, as late as February 2022, the Fed was continuing its QE liquidity injections, even though inflation was at a 7.5% 40-year high, and the Fed had rejected an immediately halt to QE at both its December and January policy meetings. This week, economist Mohamed El-Arian published an op-ed in which he states that the Fed's insistence that inflation was transitory is, quote, an error that will likely be remembered as one of its biggest ever. And pardon me for contributing to your humility on that. But my question is, has the FOMC learned from its mistake? Has it learned that unconventional monetary policy at a time when it's not needed is harmful for the economy? Has it learned that QE during a time of recovery is a recipe for inflation? And has it learned that we cannot print our way to prosperity?
Well, I think the main thing we've learned is that the supply side constraints that we saw were not as transitory as we had hoped and thought. And as I mentioned, every other mainstream economists and central banks around the world made the same mistake. That doesn't excuse it, but we thought that these things would be resolved long ago.
Does the FOMC, do you and your colleagues concede now, in hindsight, that the overly accommodated monetary stance for too long was a mistake, a monetary policy mistake?
So I'll just answer for myself. You know, that's for other people to assess. I would say that we had an expectation, and as I said earlier, I thought that always thought there was a chance we'd be wrong, and that if we were wrong, we'd be able to pivot. And we did pivot, and we pivoted pretty quickly. But by then, the economy really was moving very, very fast.
Well, on the pivot, how quickly do you expect a higher Fed funds rate, removing the accommodation, to bring down inflation, and how does that affect the pace at which you will tighten?
Well, I expect, as I mentioned, the Fed funds rate to go up in 2 weeks, and I expect a series of rate increases this year. But as I mentioned earlier, given the current situation, we're going to move, carefully.
But my concern is that to break this inflation fever now, you don't have a lot of good options. It's going to take some aggressive tightening in order to break a historically high inflation level. So, but not to belabor the point, just real quick, final time on the climate stress testing. Last year, in response to my questions about the Fed's decisions to join the Network for Greening the Financial System, you affirmed that the Fed's job was not to combat climate change. But in your confirmation hearing, you said that, quote, we are looking at climate stress tests. This will be a key tool going forward. To clarify, what is it? Is it that you will not use this, as Mr. Posey asked you, to support capital surcharges for banks serving fossil energy companies?
That's not the design or intent of the stress scenarios that we're working on right now. It is really to assist us and financial institutions who are doing these things themselves very actively, the larger ones, to understand the risks.
Well, my time has expired, but as we look at an global energy crisis with the Ukraine invasion,
gentleman's time has
critically
expired.
important we don't redirect capital.
The gentleman from Massachusetts, Mr. Lynch, who is also the chair of the task force on financial technology, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for your service and your great work. I do want to ask you a question about the SWIFT network. And I realize that the sanctions piece of this is owned by Treasury, but I'm curious if in any of your risk analyses you've looked at the possibility that if we did completely ban Russian banks from use of the SWIFT network, and it became a target of the Russian cyber forces, have we basically gamed that out, how that might happen, and do we feel comfortable that structurally and architecturally that SWIFT network would be able to resist a state-sponsored assault on that messaging service?
I'm sorry, Mr. Lynch. I'm really not the right person to answer that question. That's really a question that our Treasury Department and our administration more broadly and the intelligence groups would be able to address.
I'm a little surprised at that because earlier in your question you talked about cybersecurity and how that was in your lane in part, but I'll let that go. You did mention the recent Fed report on CBDC, and in that report, it more or less pushed responsibility back to Congress to resolve some of the major issues around the creation of a Fed CBDC, and I know that we have a working group at MIT and the Boston Fed that are doing great work on this. It started under Chairman Gensler, but now I believe Neha Narula is running that effort. In all honesty, I'm not sure that Congress is equipped by itself to make those key decisions around architecture and the shape and form of any CBDC for the United States. And, I think we are relying on yourselves at the Fed and Treasury to help us. And so I was hoping for a little bit more instruction with the Fed paper. And is there any way we could collaborate rather than pushing the responsibility on Congress with all the other issues we've got to deal with, and also with the disparity in background in dealing with CBDC and those crypto issues?
So let me address that. So what the great people in Boston are doing is really technical experimentation around how you would build a CBDC if you were going to do one, looking at different structures and options and technologies. And so that's separate from the policy questions of whether we should do this. So what we're thinking of how we're thinking of this is there's technical experimentation, there's all the technology questions that have to be solved, but there are also the policy questions of should we do this and why and how and what should be the structure and that kind of thing. So we'll be working on this project in coming years, and we hope building trust in Congress and in the public that we're doing it as a fair, honest, independent group who really is just looking out for the best interests of the country and of our citizens, and we'll be making recommendations on the appropriate structure if we do come to make a recommendation. The point is, though, that our existing statute doesn't really contemplate a central bank digital currency, so we would ideally get legislation that would be authorizing legislation, and we would take part in it. It's not that we'd be asking Congress to start this from scratch and figure out all the answers. we would be working with you to build trust in our process and ultimately come to you with a proposal, and then Congress would work its do its work and authorize.
Thank you. But Mr. Chairman, the concern is that the architecture and the security of the system will guide policy. So I believe we need to work together. But thank you. And Madam Chair, I yield back.
No, I would agree.
Thank you. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being here. It's always good to have you come before the committee. There hasn't been a Federal Reserve chairman since Paul Volcker in the 80s that has dealt with inflation at these levels that we talk about today. And historically, the Fed has been unable to reduce prices without sending our economy into a recession. And to further complicate the situation, the central bank has previously never had to deal with winding down such aggressive asset purchases to go along with increasing interest rates. You are going to have to take action on both of these pressing issues with the backdrop of what we see in Ukraine, between the Russians and the Ukraine, and the general global instability that we have. So needless to say, you have a very tough job ahead of you. So, Chairman, how do you plan on getting inflation under control without completely hampering growth or worse, causing the economy to go into a recession?
So that is exactly our objective. We're going to use our tools. We're going to raise interest rates, and we're going to shrink our balance sheet over the course of this year. As I mentioned, during this critical phase of global events, we're going to do that with care, and we'll always move with care, but particularly now. And that's how it works. We remove accommodation, and the very high levels of demand that are to some extent a result of our accommodative policy. Those rates will go up. And take housing, for example. The housing market should cool off. It's very, very hot right now, and that should happen broadly in the economy over time. We talk about getting to neutral, which is a neutral rate, which would be somewhere between 2 and 2.5%. It may well be that we need to go higher than that. We just don't know, and we don't know what events will intervene in the meantime. But we haven't faced this challenge in a long time, but we all know the history, and we all know what we need to do. I also do think, and I think it's more likely than not, that we can achieve what we call a soft landing, and they're far more common in our history than is generally understood, and that would be what you described, which is get inflation back under control without a recession.
Yeah. Well, some of us in this room remember the 80s.
Sorry? Yeah.
Some of us in this room remember the 80s and what it was like. We know that there is a lag period between the Federal Reserve's actions, and the inflammatory implications being felt in the economy. The San Francisco Fed, which we've mentioned today, admits that this latency period could last anywhere from 3 months to 3 years. And for families and business owners like myself, 3 years would be an extremely long time to deal with prices in these elevated levels. So, Mr. Chairman, when the Fed eventually decides to raise interest rates, what tools will you have at your disposal to ensure your actions are felt with as little a delay as possible, so we can once again have price stability like we've talked about?
In this world that we live in now, when we make a decision about interest rates, or frankly even talk about a decision to raise interest rates, markets pick it up like that. Financial conditions have already tightened. We haven't actually lifted off from zero, but as of a week ago, the market was pricing in, literally already reflected in financial conditions to some extent, 6 or 7 rate increases. Now, it's less than that now, and we haven't made decisions to do that yet, but our decisions get into financial conditions very quickly. It does take time, of course, for that to affect economic activity, and that's where you get 3 months to longer than that. I think by the end of a year, much of the effect is generally thought to be in. So, but that time period has already started because monetary policy really works through expectations, and we're now expecting rate increases, and they've already happened in effect, and we have to ratify them, of course.
Yeah, we're seeing them. Finally, in the past year, you have referenced productivity gains as as being key to increase the living standards for American workers over time. Unfortunately, we've seen the Biden administration implement many new time-consuming regulations that are forcing businesses, again, like mine and others, away from productive activities. The American Action Forum conducted a study that estimated that new regulations from the Biden's first year in office will culminate in over 131 million new paperwork hours. So quickly, Mr. Chairman, can you discuss the correlation between a company's regulatory burden and the effect on productivity?
So it's been, I'm a little bit familiar with the research, and it's actually been it's been difficult to make those connections in research. But we know, as a practical matter, we all want just the right amount of regulation, not too much. And to the extent you're spending resources unnecessarily, that'll hold you back.
Thank you very much, and I'll yield my time back, Madam Chair.
The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chair. During his State of the Union, President Biden reported that the U.S. has seen the fastest job growth in history. The U.S. has had the fastest economic growth in more than 4 decades, and the U.S. among advanced economies has had the fastest economic recovery from COVID. And so the inflation that we've seen is the consequence of a strong economy colliding with the supply chain disrupted by COVID-19. Given the Russian invasion of Ukraine and the inflationary pressures that could likely follow, is there a risk that raising interest rates could backfire, that it could cause a recession without actually reining in inflation? How significant is the risk of stagflation?
Well, there are several questions in there. So our goal, of course, is to raise interest rates in a way that restrains inflation and gets it back to levels that we would call consistent with price stability, and do that without while still sustaining an expansion and a strong labor market. That's our goal, and that's how we'll use our tools. There are no guarantees in life, but that is our intention and what we propose to do.
The U.S., as you know, has severely sanctioned Russia, and Russia is expected to engage in cyber retaliation. There are financial institutions, commercial banks that invest up to $1 billion every year in cybersecurity. How much does the Fed invest in its own cybersecurity every year?
I don't have a dollar amount for you, but it's quite substantial. We have very good cyber people, and at the reserve banks and at the board here in Washington. And as I mentioned a little earlier, we've been at a very highly elevated level of oversight on cyber issues since for several months now, as this event has increased, and we haven't seen any troubling incidents yet, but we remain on high alert.
The ability of the U.S. to hold rogue states like Russia accountable depends heavily on the SWIFT international payment system. In your view, how easily could China and Russia create an alternate messaging service that could seriously compete with SWIFT and seriously undermine the effectiveness of SWIFT sanctions?
I mean, that's an interesting question to speculate about. I think in the near term, that's not something you can create overnight. I know that China does have their system. It's really a question for the longer term and not for the immediate. It's not something you could do quickly like that, but let me think about that.
Fair enough. I have a question about stablecoin. The leading stablecoin issuers have chosen to peg their stablecoins to the U.S. dollar, which to me represents a vote of confidence that reinforces rather than challenges the status of the dollar as the world's reserve currency. The U.S. has no CBDC of its own and is unlikely to have one in the years to come. Do you believe, as I do, that dollar stablecoins can play a role in outcompeting China when it comes to digital currencies?
Well, I'll say it this way. I think there may well be a role for well-regulated stablecoins. I think there's the possibility over time, and this is not what we see right now, that they could be efficient and popular among consumers and things like that. I think in terms of helping us compete with China, I don't know, possibly, yeah. I think
I'm assuming it's better to have stablecoins pegged to the dollar than to have stablecoins pegged to China's currency or the currency of a
Yes, and
separate country.
I would agree with you that, in a way that is consistent with the role of the dollar. And, most of the big stable coins are, of course, dollar-based.
I have a question about the Community Reinvestment Act. Even though the CRA exists to prevent racial discrimination in matters of lending, often referred to as redlining, regulators fail to consider race when enforcing the CRA. Do you think race should be considered?
So we went out with an advance notice of proposed rulemaking a couple of years ago. We took in a whole lot of comments and took those into account, and I think we're now sitting down with the OCC and the FDIC to come up with a notice of proposed rulemaking, and that's one of the issues that we have been thinking very carefully about. And I don't have any announcement for you, but that's something that's going to come out of those conversations.
But you're open to considering it?
It's something we've been considering. We asked for comment on it.
That's the extent of my questioning. Thank you, Madam Chair.
Thank you. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair. Appreciate the hearing. Mr. Chairman, thank you so much for coming back for your Humphrey Hawkins testimony, and we all wish you the best of luck as you complete the confirmation process in the Senate. I enjoyed hearing Mr. Kustoff from Tennessee talk about William McChesney Martin, and then actually he was talking about the 70s. I guess my friend from Kentucky, Mr. Barr, brought up William McChesney Martin. And it made me think about the 1970s, and you and I both started our business careers in that decade, where inflation was really considered the #1 economic concern in the United States and around the world. And Arthur Burns was your predecessor then. And I read recently a talk he gave called The Anguish of Central Banking. Have you heard of that before?
Yeah, it rings a bell.
Well, I commend it to you. It was delivered in 1979, so he was no longer the chairman, and he was reflecting on his tenure at the Fed and also on fiscal policy of the 60s and 70s. So I commend it to you and the Federal Open Market Committee, and to my colleagues here on the committee. And with your permission, Madam Chair, I'd like to insert it in the record.
Without objection, such is the order.
It's a stark reminder that when we abandon fiscal discipline and our core financial principles instead embrace what I consider economically illiterate concepts like modern monetary theory, we get into economic anguish. And in this talk, Chairman Burns reflects on his own mistakes at the helm of the Fed, as well as the abandonment of conservative government finance, when Burns warns fear of immediate unemployment rather than fear of current or eventual inflation comes to dominate economic policymaking. And that was his warning to us, and I think it merits at this time. You said you don't want to go back to the 70s. In fact, you argued that's what we're trying to absolutely avoid. So I do encourage people to read this report, because inflation is a thief. You answered a question to Mr. Hazanga from Michigan that you were not aware that in the 2022 monetary policy report that the rules section in the monetary policy was not included. Is that right?
I was aware of it a couple of days ago.
Okay.
What I said was I don't remember any prior discussion.
Right.
But that doesn't mean it didn't happen. It just means I didn't remember it.
Right. Well, in the FOMC meetings, do they still have a presentation, part of the staff presentation, sort of a trend analysis on using those rules that have been traditionally in the policy report? Does that still go on in FOMC meetings?
Yes, it does.
Yeah. So I think that's an indication that's probably best that it be included in the report. I was looking at some forecasting about the so-called Taylor rule dating to the 1990s, which you've testified on many times. Are you aware of what the Taylor rule would indicate now in its formula vis-a-vis the inflation that we have today?
Generally, yeah.
Do you know the range that?
High.
Yeah. The answer I saw was 9.55%, which doesn't mean it's right or wrong, but it's one of those indicators about how far off we are maybe in our funds rate targeting. So I'm glad to hear that you'll consider that being put back in the report. I also wanted to raise the subject of the Fed mandate. You've taken some questions on that today, too. We've had legislation in the past to reconsider the 1977 approach Congress took in the middle of that inflation to have both price stability and full employment. And we've debated that in this committee before. And in my view, considering to the fiscal policy stimulus and the monetary policy that we've had in the last couple of years, we really have to focus on price stability. And in Congress, we're here to really prevent that kind of inflation. And I recognize, and I'm happy to say, it's both a fiscal responsibility and a monetary policy. And so I'm proposing that we go back to price stability. And we won't be alone. As I understand it, New Zealand, Canada, Australia, and the United Kingdom have that as their sole mandate, price stability. Is that your understanding, too, of those central banks?
Yes. I think the ECB, European Central Bank, so that will be a matter for Congress, obviously. Right. I would say if I were to show you monetary policy response to 5 central banks or 6 central banks, let's say, 3 of them would be like us, a dual mandate, and 3 of them would be just inflation. You wouldn't actually see any difference in their reaction function because they do have to look at resource utilization, which is employment, in order to determine policy. So we basically, you wind up with very similar answers.
Well, I thank you for your testimony, and again, wish you well in your final confirmation process. And Madam Chair, I yield back.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair. Chair Powell, it's good to see you again, sir. I would have preferred to congratulate. Hello? Can you hear me?
Yes, good to see you.
Oh, okay. Thank you so much for being here. Of course, I would have preferred to be congratulating you on your reappointment to the Federal Reserve, but hopefully we can get that done. I did publish an op-ed this morning with Chairwoman Waters and Congressional Black Caucus Chairwoman Beatty and some of my African-American colleagues on the Financial Services Committee calling on Senator Toomey to return to the table and give you and the President, the other 4 nominees, the vote that you deserve. So let me ask you a simple yes or no will do here. Do you believe that the Federal Reserve would be better able to serve the American people if it had a fully staffed Board of Governors?
I want to thank you for your kind words and support, but I wouldn't want to comment directly or indirectly on the Senate. I'm a nominee, and I await the Senate's judgment, and I'd prefer not to get into that process other than as a nominee.
Okay, well, thank you, sir. Let me switch gears and talk for a moment about Russia. As we've discussed extensively today, Russia's invasion of Ukraine has consequences far beyond the geopolitical. We've discussed the potential systemic risks the invasion poses to global markets and the mechanisms to keep Russia isolated from the international economy for the duration of its illegal aggression. But I'm concerned about the potential systemic risk here at home. The European Central Bank has identified systemically important financial institutions with ties to Russian banks, and those institutions could potentially require assistance to live up to their obligations. So are there any U.S. institutions that you're monitoring that have outsized default risk as it pertains to the freezes on Russia's assets?
So basically, no. Our financial system and our financial institutions have relatively little exposure to Russia, and even the largest exposures that any of them has are not very big. So it would need to be exposures. It would need to be a second order thing whereby a foreign financial institution has exposures to Russia, but also has exposures to our banks, and we don't see that as a primary risk, but it's something we're watching.
Okay, so with my remaining time, let me ask you, your November report indicated that the forthcoming rise in interest rates will have ripple effects throughout the entire economy. Can you speak to the interconnection between the Fed's rate hikes and the freeze on Russian assets as it pertains to the prices of certain commodities?
Well, I think commodities are, the price of commodities is generally set on the world market by supply and demand. We do intend to raise interest rates this year, as we've said, but as long as we're in this very sensitive phase of events in Eastern Europe, we're going to be careful in doing so. We're going to move, avoid adding uncertainty, as I mentioned a little earlier. And we do believe that over time, as we raise interest rates and as we get relief from supply side improvements as well for inflation, that we'll get inflation back down. We expect to see that happening, and to the extent we don't see it happen, then we're prepared to move more aggressively.
Great. Thank you very much, Madam Chair. I yield back.
Thank you. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Pro Tem Powell, for being so forthright. I think your answers to Mr. McHenry's questions at the outset were incredibly helpful. I think it was probably the most direct that you've been with respect to how you're viewing interest rate policy heading into the March meeting, and I certainly appreciate that, and I suspect others do as well. So thank you for that transparency. I want to start on Ukraine, and I know this is Ukraine and Russia, and I know this is just evolving. My view, despite some of the, what I thought was a little bit flowery rhetoric last night from the president, is this is the beginning of a long-term conflict. This is not something that will be over in a matter of days, but months and perhaps years, as the Russians encircle Ukraine and our lack of response in many respects. I know you're a student of history and you're a student of monetary policy history. When you look at a world where this is a longer-term conflict, how do you view a longer-term military engagement in Europe impacting rate policy and balance sheet policy? And if you haven't begun that study yet, is that something that the Fed will endeavor in the coming weeks and months?
It's a really good question, and I would have to agree with you that this event does seem to be one that is a game changer and will be with us for a very long time. As I mentioned, we don't understand yet. There are events yet to come that we haven't seen, and we don't know what the real effect on the U.S. economy will be. We don't know whether those effects will be quite lasting or not. But it's something we're going to be thinking about a lot. It's exactly the things we'll be thinking about. Too early to say, but it's not too early to try to imagine and assess.
Thank you, and I know my thoughts and prayers are with the Ukrainian people, as are many of my colleagues, all of my colleagues. I think we were unanimous in that. We hope for a successful outcome, though admittedly the days ahead appear to be quite choppy, and it's hard to see a positive outcome in the near term. I want to shift to another thing the President said last night around companies need to lower their costs, not their wages, and that's how we're going to fight inflation. That sounds wonderful. How do you magically sort of lower your costs as a company? Is that something? It sort of implied that it's corporate greed that's leading to inflation. I've read your comments. I think they're spot on with respect to the supply-demand dynamics. But is there a way for companies to just sort of unilaterally lower their costs that you're aware of?
First, I
know you didn't see the speech.
Never comment on the president's comments at any time, and I won't do that now. I think my experience in the business world very much was that businesses are constantly managing their costs. That's a lot of what businesses do. So it's an ongoing thing. But I didn't watch the speech, and I don't know the context, and I would never comment on anything the president says. So,
thank you. Shifting to my last question, there's been talk of whether cryptocurrencies represent a good vehicle for sanctions avoidance. I think you've rightly said that's maybe for the purview of Treasury, but generally speaking, a system that transactions occur on a public ledger that are auditable and reviewable by the entire world. Anybody in the world can go and check and monitor these things. And in a world where those same systems have transaction speed limits, essentially. Do you think in that world a public ledger is a good or sort of less good way to launder money or avoid sanctions?
I don't want to. I'm not an expert on sanctions, and so I'm reluctant to comment on that in the context of sanctions, just because it's not our field. I would say a public transaction. There's a balance you have to strike between privacy, which is very important, but also the ability of law enforcement and national security to track payments. And I think to the extent that cryptocurrencies are a means by which you can evade both law enforcement and national security concerns, then that's not something we should tolerate.
Thank you. Thank you for, again, your transparency, and I yield back.
Thank you.
Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, and thank you, Chair Powell, for being before us again today with such forthright testimony in such challenging times. I wanted to just start on the question of inflation and something that you said to one of our colleagues in response to a question. You said that inflation is too high. We're seeing it everywhere in the world. Ours is worse because our economy is stronger. Can you flesh out that duality a little bit, maybe by way of contrast with others globally who are struggling with inflation but do not have a strong underlying economy?
Sorry, I think if you look at our, maybe the closest economies and political systems would be the countries of Western Europe and Canada. Advanced economy countries like that, they're all having the highest inflation they've had in a very long time. Places like Germany, which is famously, inflation averse, has high inflation. Now, ours is a little higher. Our economy is now well above the level of output that we were at before the pandemic. If you just look at the output an economy had before the pandemic to where it is now, we're way above that, and other countries are kind of just getting back to that level. So we've just had a stronger recovery, and that is because of monetary policy and fiscal policy and also just vaccines and a whole range of factors. So our inflation is definitely, of the advanced economies, ours is higher generally. We're going through the same process that the Bank of England and other central banks are going through, which is raising rates and trying to get inflation back under control. Very committed to doing that. It's a common problem. Again, ours is worse because our inflation is higher, largely because our economy is that much stronger.
And I know you have a series of meetings and possible rate hikes. You talked about in 2 weeks, likely the 25 basis points increase. For my constituents, my consumers, what impact will they begin to see with the small incremental rate hikes?
So it's a little bit like the rate hikes that took place in the first part of this century. Not the rate hikes that took place after the global financial crisis were much slower. They were every other meeting. But the cycle before that, the rate hikes are consecutive meetings. So what you feel is these are fairly small rate increases, 1/4 percentage point every 7 weeks. And we haven't made any decisions after this meeting. But the thought is that rates move up, our policy rate moves up, and with it, rates on mortgages, rates on car loans, rates on the loans that people take out to buy appliances and things like that. So companies, their borrowing costs go up, and you get to a point where you've raised a few times, and it's even still a gradual process, even though it's fast, as much as twice as fast as the last cycle. But still, people start to spend a little bit less, and the economy demand returns to a lower level. By this time, we hope that that the economy is going back to normal in terms of supply chains and the breakdown between goods and services spending and things like that. So we hope we're getting help on the inflation front from a bunch of things. In any case, we do have the responsibility to generate price stability, and we will use our tools to do that over time.
I thank you for that. One particular area of concern for me is the role that increasing market consolidation has played in contributing to inflation. An example that we've seen is the huge price spikes in the meat industry, which has become incredibly consolidated. To what extent would you attribute supply chain fragility and recent price increases to market concentration?
So we're not the competition authorities, and so I would defer to the competition authorities on all those questions. In terms of inflation, though, inflation really is mainly a macroeconomic phenomenon, and which doesn't link in the aggregate very well to concentration. Some of the most concentrated industries, in fact, were those that drove low inflation. I'm thinking there of warehousing and retail and things like that. Those industries consolidated and they drove lower prices. So it's not so obvious. There clearly are industries where that may be the case, where they've become consolidated and they're able to raise prices. It's not clear they'd be able to generate an inflationary cycle, but they could certainly raise prices in the first instance. It's not a settled question in the economics, but again, we defer to the competition authorities.
Gentlewoman's time has expired.
Thank you, Madam Chair.
Thank you. The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Madam Chair. Inflation remains a serious concern for my constituents in West Virginia. Inflation erodes the real value of every paycheck. When the cost of filling a tank of gas or buying groceries increases, all Americans lose money. Today, I'd like to focus on a slightly different aspect of inflation, which is inflation's corrosive effect on Americans' savings. The combination of low interest rates and high inflation has clobbered returns on common savings tools like savings accounts, money market funds, and certificates of deposit. January's 12-month consumer price index of 7.5% pushes the yield on these savings tools into deeply negative territory. In other words, with inflation as high as it is, Americans who have saved responsibly for years are losing their money over time. So, Chairman Powell, first question is, how concerned are you about the effects inflation and negative savings yields are having on the long-term health of our economic recovery?
So I would agree that inflation falls heavily on people who are living on, for example, bank deposits and CDs. And this is typically retired people and the elderly. And, of course, they do bear the brunt of this. So that's why we need to get, one of the reasons we need to get inflation back down to appropriate levels, and that's what we're working on.
Thank you. Savings is an important way to achieve financial goals like purchasing a new home, paying for college, or retirement. Savings is a way to take control of your financial destiny. Savings is a part of how we can achieve the American dream. So I'd like to raise another potential issue about the declining value of savings and its implications going forward. I'm concerned that our current economic environment will discourage savings altogether. So, Chairman Powell, are you concerned about the effects inflation and negative savings yields could have on Americans' incentives to save money going forward?
Interesting. If it were to persist for a long time, I would be concerned. Of course, right now, savings are, the level of savings on people's balance sheets is at historic highs because they saved during the pandemic. They weren't able to spend money on travel. So right now we're looking at a couple $1 trillion of savings above where they would have been without the pandemic. But over time, yes, savings is important, and I would agree that high inflation can be a disincentive.
Okay, thank you. I think it's important we monitor the savings rate closely with this in mind. If Americans save less, that could have economy-wide implications both now and especially in the future. So we should be careful to ensure monetary policy encourages savings going forward. And that's all I have. Thank you, Madam Chairman. I yield back.
Thank you very much. The gentlewoman from Texas, Ms. Garcia, who is also the Vice Chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Pro Tem Powell, for being with us today and I think I'm going to be last, so I'm trying to try to be soft. In a recent press conference, you had mentioned that forecasters expect inflation to subside as supply chain disruptions issues are resolved. I understand this is being addressed, and my colleagues and I are working on addressing this supply chain crisis through multiple legislative solutions. At home in Houston, one of the nation's shipping and energy capitals, we are focused on expanding and developing the nation's ports and waterways to continue building our role in facilitating global energy and trade. You also said in your remarks today that we understand the high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. So I want to focus some on housing. In Houston, housing costs have skyrocketed, with the median price rising 18% last year and the average 16%. Nationwide, housing and the rent prices account for roughly 1/3 of the CPI. And most economists do not expect this problem to be resolved as quickly as supply chain bottlenecks. In your earlier exchange with my colleague, Congressman Williams, you mentioned a soft landing, wherein the Fed will address inflation first and survey the housing prices trending downward. My question is this: is the Fed looking at alternative plans in the event that housing prices do not trend with inflation? How might that impact inflation reviving if low housing supply continues in the upward pressure?
So we do, as you mentioned, housing costs and housing services costs, and if you're a renter, they're a very big chunk of what goes into the inflation indexes. And to the extent housing prices, we're not saying they'll go down. What we're saying is that the increases will be much smaller. We don't need housing prices to actually decline, just as long as what we can't have is we don't want to have them increasing at very high levels as they have been doing. Largely as a function of supply and demand. You know, supply is constrained. I don't know about Houston, but many places in the country, difficult to find lots, difficult to find labor, difficult to get materials, or materials very expensive.
We're experiencing that.
Yeah, and so demand is very strong. So interest rates are low, and what you get is a lot of buyers and not enough new houses. So what will happen as we raise interest rates, and this is already happening, it's already priced in, is mortgage rates will go up, and you'll see that bidders, prices will begin to go up more slowly, demand will decline, and hopefully we'll get back to a place where demand and supply are well aligned.
Will we ever get back to the pre-pandemic levels?
Will
we get back to the pre-pandemic levels?
Of price?
Yes, sir.
No, I would only expect that we could limit further price increases. We're not trying to drive prices back down. What we're trying to do is limit future prices.
Right.
Increases.
Now, how concerned are you that there seems to be a lack of investment in affordable housing, and how that could cause inflation to become a long-term problem, even if the Fed is able to get inflation under control in other segments of the economy? So now specifically about public housing.
Public housing is, of course, not our policy tools don't generally meet the need for affordable housing. It's really more of a fiscal policy and a housing policy question. But I know that economic research shows that high housing costs for workers are making it difficult for people to live close to where they need to be going for work, and it is limiting the ability of people to be in the workforce and ultimately limiting our economy. So I will say that.
Last question. You mentioned in your remarks that it impacts essentials like food, housing, and transportation. What does this do to the poverty rate, increased inflation? And because I know unemployment is down, does that necessarily mean poverty is coming down, or does it continue to rise with inflation?
So those things would have offsetting effects. To the extent inflation is going up and faster than people's wages, and that's actually not the case for people at the lowest end of the spectrum, because that's where the highest wage increases have been in the aggregate. But to the extent that were happening, that would potentially increase poverty, but to the extent people are going back to work, that would decrease it.
Thank you. Madam Chair, I yield back.
Thank you very much. I'd like to thank Mr. Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask Mr. Powell to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.
All right, so with this hearing adjourned, just give me a second. I'm waiting for my feed. But with the hearing adjourned, let's get some really important points here out of the way, and some of them that I think you guys have all noticed. And let me put my glasses on so I can read a little bit better here. But what some of us have all noticed was that they were definitely dodging questions around CBDCs. They were definitely dodging questions around crypto. One of the things that really, really bothered me about this whole thing, and let me know how the sound is real quick, everyone. Let me know. But anyways, what really, really bothered me about this whole thing, okay, was when they started talking about how cryptocurrencies are used to get around the government. They're used for bad reasons, right? Get around government, get around taxation, all that kind of stuff. And what I really wanted to hit home the point was this. What about cash? What about cash? What about the Fed that is out there just printing money over and over and over? And that with the Fed printing money, all right, and all this kind of fun stuff, all right, isn't the Fed, what they were doing, just completely illegal and completely insane? I mean, let's be honest here with everyone, right? The Fed just kept printing money after money after money. After all of us are out there saying, hey, inflation is hitting us, inflation is hitting us, inflation is hitting us, and they did nothing about it. They just kept printing more and more money. That's thievery, right? Because think about it. So now that the Fed has completely just been a mess, all right? That the Fed, I'm sorry about the sound. If the Fed is just a complete mess, let's be real here. All their money printing is now causing massive, massive issues when it comes to inflation. All right? Like the guy said, hey, if you're putting money into savings right now, you're actually losing money because it's getting eaten up by inflation. Your savings is getting eaten up by food costs, all of that. It is a complete mess. So when I'm sitting there and when I'm watching these guys and they're talking about, hey, crypto, it's used for shady things. Look how Russia's getting around sanctions with crypto. Shut the hell up. Like, seriously, look what the Fed has done with interest rates, all right? Look what we have been talking about, all of us here, and I had it. And hopefully you guys like the format of that live stream. I was just a couple minutes late getting it started. But right now, okay, I have the Fed chart for housing, the Fed chart, for housing up. Look at what housing has done. And actually, let's switch to the whiteboard so y'all can see it so I can move it out of the way. Look at this raise right here in housing. All right? Any money, any extra money that people have made, any extra savings that people have added is now being eaten up by interest rates. Are going to be raising soon. So anyone out there who's buying a house, guess what? Your house is going to cost more. Why? Home prices aren't going to go down right away. It's going to take time. But home loans are going to go up as the Fed starts raising rates. We know this. It is going to happen. And now on top of it, you've got food costs, you've got energy costs, you have all these other economic factors happening. And what is it doing for us? It's making our money worth less and less and less and less. For a long time, I have been telling everyone out there, do not think the crypto market will come back as we're going through this transition. Why? Because if you're buying a house, if you're buying a food, if you're paying for bills, your bills are going up, 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 which means the free money you have left to spend on crypto or any other investment out there become less and less and less and less. That is why you're not going to see a retail boom drive crypto. That is why when we start looking at the charts here, and that's why I started putting silver up on the screen. That's why I had gold up on the screen. That's why I had oil up on the screen. All of this that is happening right now is pulling less free money away from the spending public. All right? Think about this. Think about this, all right? Last year, during tax time, how many of you put some of that tax money into crypto and in other investments? Think about that. Now this year, and Marquise, I'm going to get to that, all right? Marquise, I'm going to get to that. Now this year, how many of us are spending money on crypto investments and all that? No, it's getting eaten up by bills. I talked to my wife already about this, all right? And even my wife said, she's like, yo, I was just at the grocery store again. The eggs went up again. And we're like, oh my gosh, come on. And it's nothing. It's nothing. The money is going less and less and less. So Marquise says that's why people need to make your home make money for you. For everyone out there, again, all right, I'm going to just tell you how I have done things. You guys can say what you want. You can make fun of me for all you want. I carry one loan. I have one loan. We have one loan in our entire family. One loan. And it is my wife's car payment, and her car payment is like $160 or $170. That's it. House is paid for. We have 0 credit cards. All the other cars are paid for. Everything has been paid for. We have busted our butts over the last 8 years to pay everything off because we saw turmoil just increasing. So for people out there that are taking on extra debt right now, you're going to get in trouble because inflation is just going to keep making your money, your paychecks, your savings worth less and less and less. So Marquise says you have to make your home has to make money for you. Sorry, Marquise, if I was paraphrasing that, but I know what you're saying, dude. And that's what we did as a family. That's exactly what we did with a family. We own our home outright. Is it the biggest, nicest house I've ever seen? No, it's not. It's half the size of our home when we lived up in South Dakota, but our home is paid for. We've been able to contrarian invest so that we don't get caught. So as crypto goes down, my safe haven assets go up, I'm safe. All right? For any of you out there that have credit card debt, think of the number of people in this world that have credit card debt. As the Fed's interest rates are going to increase, your credit card bills are going to be increased. All right? Think about that. And for those of you out there, Khalid Muhammad is a legit person. He is a legit person. Very, very cool cat. Very cool cat. But think about this. All right? As these food prices go up, if people are putting their money into cash right now, your cash, you're not making any money on cash, but prices are going up, so you're losing all the time. The only way to beat the government right now with what they're doing with our money is to be a contrarian investor. You have to buy stuff that people don't want, sit through the pain, and when people want it, you charge them big, big, big rates. The beginning of this channel, when I first launched this channel, I covered a lot of stuff on gold and oil, and it sucked. And it sucked. No one liked it. Everyone made fun of me. They're like, you're a friggin' loser. Why are you investing in oil? Why are you investing in gold? For times exactly like this. Because whatever you have to balance it out on the opposite end of the spectrum so you don't get caught with your pants down. And that's what's happening right now to the American public. And actually the global public. All right? And Meparatus said, thank you, Meparatus, for saying that. Meparatus says, people that are already wrecked are going to get even more wrecked. You bet your butt. If you are taking loans out now, if you are doing all that stuff now, you are going to have your ass handed to you. I kid you not. There was one of the Congress guys, all right, that when we were watching this, said, so how do you streamline and cut costs? You fucking idiot. That was my whole career. I retired at age 38 because I was so good at what I did. I could walk into any manufacturing facility and I could tell you how to cut costs. I could tell you exactly how to increase efficiency, and I can do it without laying off people, And I could do it while increasing sales and increasing the value to the end consumer of the product, right? The product to the end consumer. The government is not efficient. Long time ago, I learned that because the government is not efficient, I myself, my family, has to be way more efficient. We have to be way more financially stable than the government. We always have to be ahead. That is why, all right? That is why I have always been a contrarian investor. I got my ass handed to me in oil for a long time. But I was buying oil when all of the Rona stuff happened. And the world just started, you know, when they started shutting down the planes, the airports, you know, travel and all that stuff. I was like, so you're telling me oil's going to always be dead? No. And that's when tech was hot, right? You guys remember that. So while tech was blowing through the roof, what was Big Daddy Klaus doing? I was buying oil that was beaten down. So now while everyone's freaking out that their investments are going to crap, no, your investments are only going to crap if you only invested in one thing, if you're only a one-sided investor. And what we saw with the whole global economy, with Canada, the United States, Europe, all the countries out there, all right? All the countries out there, all right? We're printing money like crazy. They put us in lockdowns. They gave us money to shut us up to make us happy. And all that money, what did people do? People pissed it away. People pissed it away. They pissed it away. How many people used that money from the governments, put it into stock markets or cryptos and lost? Because they didn't know what the hell they were doing. How many of people use that money to pay down their debts? Think about it. This is exactly what I have been trying to tell people for the longest time, and I swear a lot of times it's falling on deaf ears. Sniff, you have a good one. I'm gonna piggyback of what Sniff says right now. Sniff says they're gonna create some kind of phony climate or outer space threat. Sniff. The next thing right now, and they've already talked about it, is global lockdowns for climate healing, okay? When the Rona shut us all down, all right? And don't worry, yeah, Khalid, yeah, guys, everyone out there, Khalid, is good person. Good person. I got to admit that. Khalid is a good person. Really good person. West Coast, right? West Coast, buddy, I got you. But when all of this was happening with the Rona, we were going through all the lockdowns and all of that. The government was forcing us to do something, and then they make our money worthless. Why? By printing tons and tons of money and not fixing problems. So when that congressperson was up there and saying, how do we make things more efficient? How do we cut costs? You're a fucking idiot. You are a fucking moron. And I don't mean to swear, but this really pisses me off. Because we can make things more efficient. We can make government spending more efficient. We can make businesses more efficient. I've done it myself. I've done it firsthand. I have literally walked into a manufacturing plant and I have torn the thing down from top to bottom. And I'm going to get to climate hearing. I'm just going on a little rant. I've torn it down from top to bottom, and instead of closing plants down, I've been able to extend them and to get more hiring because we're able to drive better end result to people out there. And see, the dogs can tell I'm getting all like animated, so now the dogs are all freaking out at me. So with climate hearing, let's talk about climate hearing, all right? Here we go, climate healing. When we all went into lockdown with Rona, right? When people weren't traveling, when planes weren't flying, when we weren't in Thailand vacationing and all that, the world started healing itself, right? Coral reefs got a little bit better. Pollution went down. We saw it, right? 'Cause it's simple. Not much is happening. You know, the air cleans up. How much it cleans up, we don't know. Hard to believe the stats. But they already said if we have a global climate crisis, the number one solution would be another lockdown. And guess what? If they lock us down again for a global climate solution, all right, they would have to print more money to pay for us to stay home, which means what would happen yet again? Inflation would go up. The value of your money would go down. Safe haven assets would take off as high-risk assets plummet to the ground. All right? This has all been out there. So when it comes to debt, when it comes to climate, when it comes to all of that, you have to be fortified on both sides of the equation. So let me ask you this. I put this out in a video. I don't think many people watched the video. Why do I think that? Because I have the stats on it, because, oh my gosh, that's at least one cool thing is I have the stats on it. I made this video, this frustrated with XLM video. I have almost 5,000 subs and there were only 1,200 views. Only 1,200 views. And a lot of people didn't like the video. This is one of my lowest rated videos, 92%. I basically say, hey, look, if you are getting beaten up with your crypto investments or with your crypto holdings, you have some options. Here are your options. But most people did not watch that because most people, they just want to bury their head in the sand and pretend it's going to be okay. How many of you out there, and I'm not calling out any specific channel right now. I'm not doing that. None of that crap. How many of you out there have watched those crypto channels? Moon Lambo, we're going to the moon. And they say it 24/7. We're getting to $100. Blah, 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 blah. Shut up. Crypto is going to get there, but now is not the time because global economic policy will not let it get there. It is not the right season. All right? Ooh, Marquise, yes. Marquise, that's right. Universal basic income. That's why they were pushing for universal basic income. This is exactly right. And so think about all of this right now. All of this that what we're dealing with. These are all government-created issues. All right? Let's talk Rona, and let's not be political about this, all right? Let's not be political. Let's just go science, and let's go science without stupid stats that we're hiding figures from. When the Rona happened, did the government ever once come out and say the best things for your immune system are to drink water, to get rest, to exercise, and to lower your weight? Did they ever say anything about preventative medicine? No, they did not. In fact, what did they tell you? Go inside, shut up, we're going to give you checks. Here's money, we're going to give you checks. We're going to give you stimmy payments over and over and over to keep you shut up, keep you happy, and keep you inside. Not once did the government say, hey, look, seriously, people, we really got to be careful with stuff. You know what? If you want to watch out with the Rona, you got to take care of yourself health-wise. No one said that. No one was saying that. And in fact, you would get in trouble if you said that. Oh, that's bad. No. The science all along has been that the healthiest people live longest. Right now, what is the number one comorbidity with the Rona? Obesity. Obesity is the number one comorbidity with Rona. So now what did the government do? The government said, hey, forget going outside. Forget exercising, because if any of you lived in Michigan, you guys know all of that stuff was banned, right? All those outdoor activities were banned. They were banning fishing, all sorts of crazy stuff. Parks were shut down. Everything was shut down. No one was talking about exercising. No one was talking about preventative medicine. And yet the number one comorbidity with Rona is obesity, diabetes, tagged just like that. The government's control over us with misinformation is one of the biggest, craziest things I have been watching over the last few years, and it is frustrating. It is so frustrating. And again, I'm not getting on politics. I don't want to get on policy because I hate it. It's disgusting. But do you guys remember what happened with the Rona, right? With oil? Remember how we stopped investing in oil exploration? Remember when they pulled the plugs on pipelines? Why would we pull the plugs on pipelines when oil was its cheapest ever? Why? Why would we do that? That is when you ramp up production. You ramp up production when things are its cheapest ever. Why? Because when it's worth more, you'll have that much more in the bank to sell it to people to screw them over. OTA says Germany had over a 1-year-long lockdown. Exactly. During that lockdown, think about this. I'm a really big fan of Thailand. I love Thailand. Oh my God. Before I die, I'm going to visit Thailand. I've been a bunch of places in the world, but I've not been to Thailand. Do you know in Thailand they lock down public parks and tracks and all that outside? Why? Why? Why are people not opening their eyes up to what is going on? Oil is not going to stop. The price you pay at the pump now is nothing compared to what you're going to pay in May, June, and July. Think about this. Summer blend for fuel is more expensive than winter blend. We also have yet to go through what's known as our oil refinery maintenance cycle, which shuts down plants. You see my thing? The government is not leading you down the right path. It's simply not. If I told everyone out there, hey, guess what? Guess what? You want to beat the Rona? Stay home, get healthy, exercise, lose weight, get fresh air, all of that stuff. I would have gotten strikes on my channel. I would have been labeled as misinformation. But oh no. Let's keep people inside doing nothing. Let's keep them behind their computers. Let's have them watching Netflix and all that. What a joke. Gary Tollin says, never took a check or stayed inside. Gary, when the Rona happened, I kid you not, and it's one of the coolest things that happened on a Rona. I've always been an outdoors person. We've always had the windows open in the house. I'm always outside with the dogs. With the exception of days like today where I'm streaming for hours and hours and hours, I am outside almost the whole day. Fresh air the whole day. Exercising all the time. Like, I exercise every day. I watch what I eat. If you look at what's on my desk right now, right in front of me, I can't make this kind of stuff up. I have my cleansing pills, right, to help me detox. I've got my Powerade Zero, and I've got my water. That is what I have up here. There's no sweets, none of that stuff. I mean, come on, man. Like, this is all out there for everyone. And so for everyone out there that's all like, oh, it's going to be Moon Lambo, people realize we have to go through certain steps first before we get there. The oil market needs to clear all of this stuff out. Gold and precious metals need to clear stuff out. I told everyone, if gold stays above 1900 for an extended amount of time, we are going to be in hurt. A real bunch of hurt. Gold's trying. It's hit that 1950 twice and faulted. It's hit it twice and faulted. But when the feds raise interest rates, and I'm glad I'm bringing that up, because I'm going to go to here, because I want to show you something. Hey, there I am. I'm live on the screen. How freaking cool is this? I put a poll up. So, how much will the Fed raise rates this March meeting? A quarter of you out there think that the Fed is not going to raise rates? What? That tells you how far off the viewing public is regarding what is happening financially right now across the world and in the United States. Khalid Muhammad, and Khalid, glad you were here, sir. Glad you were here. Khalid says, Klaus, remember when the MoneyGram CEO told us at the SDF seminar that they've been working with Stellar for over 5 years? That statement says alone what has been going on behind the scenes, and that's exactly my point. You cannot follow the news. You have to be ahead of the news. So let me ask you this. What good companies and what good sectors are just beat to ever-living hell right now? Tech. If we go in another lockdown because of cyber threats, global warming concerns, all that kind of crap, we'll go into another lockdown, which means tech will go through the roof again. Through the roof again. Twitch Radio chimes in. I didn't know the Rona happened until like a month later because I was on Mount Rainier. That's my point, man. That's my point. All right? They are going to raise it. They are going to raise it, and they're going to raise it quick. And so this tells you right now, think about this. 1 in 4 people right now thinks the Fed is not going to raise rates in March. As soon as the Fed raises rates, crypto is going to go down. What was the tone? What was the tone of this meeting? They stayed away from talking about CBDC. They were talking about how crypto is used to dodge government sanctions, how crypto is used nasty, all of that kind of stuff. That is going to send crypto down. Crypto is not ready yet. It is not ready yet at all. All right, Marquise, you've got the right idea. Tech will explode. That's my point. If you want to protect yourself against what governments have been doing to us all across the world, you have to be a contrarian investor. Being a contrarian investor sucks because your teeth are kicked in all the time. And Marquise, Marquise is the man on this one, guys. Seriously, you got to listen to Marquise. He knows what he's talking about. That's why I'm so glad he's on the channel. Because you're right, if lockdowns happen again, tech will rise, oil will go down. Precious metals will go up because the harvesting of precious metals will be more profitable because the energy price to produce them will go down. That is exactly what happened in the beginning of Roni Rona. Oh, right here. See this spike right here in gold that happened March 15th to here? The reason gold went from 1,500 to over 2,000 is because gas prices were down. All right? Gas prices are down, so at their cost, right? The biggest cost to harvest precious metals was down. And lockdowns and uncertainty cause safe haven assets to go up. It's frustrating. It's very frustrating. It is extremely frustrating to watch this. It is very hard. Now, that being said, you guys have known, I've been talking about companies like Purple. Do not invest in companies like Purple. Do not invest in companies like, but look at this. Look at this pattern for Purple on the screen, right? During Roni Rona Tech, ooh, it's good. And then once we kind of have a handle on Roni Rona, boom. And Sniff, thank you for that. Sniff says, are you on another platform where you can discuss Freemasonry, Judaism, and Babylonian Talmud, all roads that lead to these topics? I am not on another platform. I've thought about that, Sniff. I actually have. I've thought about doing something like that because, you know what, I have to watch what I say YouTube-wise. I really do. I have to watch what I say YouTube-wise because I have gotten a few things demonetized, which sucks. It really does suck. But look at this right here, guys. This is telling you what exactly is happening. And let's get to some of these comments here, all right? So we got Meparatus up on the screen. It says, I'm having trouble understanding how governments are going to be able to lock people down again here in Canada. It's going to be a war zone if that happens. Yeah, I think that's the problem, though, is they used fear. And look what they did in Canada. And for those of you that don't know, that is why I'm going to D.C. this weekend to play Pokemon Go. I want to report about the trucker convoy that's coming to D.C. playing Pokemon Go with me. All right? People will not put up with this. And people are getting jerked around. And Sniff, you're good, man. I know exactly what you're saying, but I got you. But this is exactly what we've been preaching on this channel. We have been preaching on this channel, you need to be smart with your money and you need to read between the lines. I don't know if you guys caught it earlier. I was talking about Marquise. Marquise is doing exactly the right thing. Marquise is going to buy real estate with commercial on the lower level, all right? Residential up on top. He is insulating his highest cost by having someone else pay for it. Oh, I got you, Sniff. Don't worry about it. I got you, man. I got you. No worries, dude. I got you. Trust me. It's the channel gets enough heat. It gets enough heat. I mean, this is it, guys. This is what we've been talking about. So now, right? For crypto to go up, right, and all that, we're gonna need to see the world turmoil kind of slope down a little bit. And let me ask you this: is the world going to slow down turmoil-wise when we have a midterm election coming up? Is the world going to slow down turmoil-wise as we're all freaking out about Ukraine? Because remember, we're all freaking about Ukraine, but what did we all forget about? We all forgot about the trucker convoy. We all forgot about all the COVID stuff. Just throwing it out there, all of that gets forgotten about, didn't it? All the civil unrest, all the inflation stuff, that's gone. We're all worried about Ukraine and Russia, Ukraine and Russia. It's all a distraction and it's all market turmoil. All market turmoil. Twitch Radio says, I'm the same type of investor as you. I can't spell it out though because I've just been doing whatever somebody else doesn't want it and I'll take it and I'll just hold on to it. It's true. It's very true. Would I suggest buying oil right now? I really don't think I could because, like, I think you missed the boat on it. You had to have been buying oil way back when, guys. Khalid Muhammad says, I hope everyone here invests ISO and holds during this roller coaster ride. Yeah, contrarian investing. You buy stuff that people don't want and you buy it dirt cheap. What is dirt cheap right now from good companies? Find good companies that are getting beaten up right now because they're not hot, because it's not their time in the rotation. Find those companies, okay? Find the ones that are the most beat up with your best balance sheets. Go for that. And when money rotates, boom, you're good. Monarch chiming in. Great one, Monarch. We'll see if China-Taiwan keeps the disruption going. Because remember, we're going to be talking about Ukraine right now. All right, you guys ready? We're talking about Ukraine right now. After Ukraine, don't forget, in the U.S., we still have inflation to freak out about. We still have interest rates. Yes, everyone, we still have interest rates that are going to bite everyone in the butt. We also have China-Taiwan situation, which is really not the best, which is kind of swept under the rug. There's a whole bunch of things. And let's be honest here. Does anyone want to bet me that the next variant out there is going to cause concerns? Brad Mills, good comment, Brad. Good comment, Brad. I'm going to have to give you the old gold star we do on this channel. You can't get past the science. Political science, that is. Yes. Yes, yes, yes. Those of you that know me, like that have heard me talk before, my background is massive chemistry, physics, and statistics. I'm a Lean Six Sigma person by trade. I am hardcore Lean Six Sigma, hardcore stats, hardcore. The stats guide my decisions. How, as the American public, can you make the right decisions regarding Rona and all that when the CDC themselves are eliminating the biggest chunks of data? I would have been fired from my job if I went to all the big high-ups in my company and said, you know what, here's the data that you guys wanted to decide if you want to keep this plant open or shut it down, but I eliminated the majority of the data. I had been fired on the spot like that. They'd be like, you idiot, what are you doing? That's what the CDC did. All right? Yeah. Khalid Muhammad says, watch everyone run into the metaverse to escape reality. That's the other thing, right? When the lockdowns happen again, you're going to see again a movement to the metaverse. People escaping. All right. Meprata says, for what it's worth, on the technical analysis side of XLM, we are testing our breakout of the triangle. Nothing is technical right now, though, guys. You're going to watch this falter. And I'm not being negative on XLM, but what I'm telling you is this. I want you to focus on this little bump right here. Remember when stuff was really bad and we were sub 19? And then we had this fake run up and people are like, oh yeah, crypto is going to go. All right, think about that. And then look what happened. Turmoil knocked it right back down again. And now we're back at this floor. You see we're back at this floor just like we are right here? We ain't ready yet. We ain't ready yet. Sniff has a good comment. This made me laugh. Thank you, Sniff. I kind of needed this today. Sniff says, if I lose my house, I will just live in my mansion in Decentraland. I'm telling you guys, it's there. Michael O'Toole Canada is one big prison right now. Yep, that's exactly right. Marquise chimes in. Oh yeah, I know it's going to be a new COVID because they said 3 weeks ago the vaccine is wearing off and it's getting stronger. Yes. Mark my words, save this on the live stream. As soon as we're done with Ukraine tension, as soon as it's not hot in the news and ratings go down, all right? As soon as ratings go down, they're going to bring up the next scare. Twitch Radio says, worst case scenario, I'm a survivalist. I'll just move my family out to the mountains. Twitch Radio, I am with you too. I am with you too. I can survive quite easily outdoors. I don't know if my kids can without all the digital stuff, but yeah, I'm very adept and capable at outdoor survival. I would be okay. And I got my doggies too. They would help me out. Brad Mills says the cost of oil production does not fluctuate that much, only how much you can sell it for. The biggest expense, Brad, in oil and energy production is the actual fuel cost it needs to produce it. That is your biggest variable cost in oil production right now is literally what your cost of gas is to run your equipment, cost of gas and diesel. And that's mostly on the shipping end of it, not so much on the retraction end of it. Something out there. Monarch says, there was a talk of a stealth COVID going around, brushed aside as well. See, what it is COVID Rona right now. All right? Rona right now. Let's be real here. Rona right now is not in the news. It's not hot. So the news isn't going to care about it. All right? But when we all get, because think about it, honestly, even your biggest, quote, Rona fearmongers out there are really getting tired of it. You're noticing it in Congress, right? They take their pictures in front of the media with the masks on, but then as soon as the camera's gone, the masks go off. See, even they're getting tired of putting up with the charade. This is what this is about. It's the control of population, control of information, and people need to understand what they're dealing with. Brad Mills, another good comment. Gotta love it, Brad. I identify as wealthy. Doing that alone should buy me a Lambo, I think. Yeah, you just have to identify with what you want. That's what we've learned in this world, right? Forget reality. Identify whatever the hell you want. Ooh, sorry. Levels of Madness says, with the cost of barrels of oil being this high, oil companies will start fracking it. And actually what's going to happen is they're going to fire up exploration again. So what happens is in the oil industry, as prices go up, different wells get turned on because each well has a different cost that they break even at. Some wells break even at $30 yield. Some of them are at 40. Some of them are at 100. Your deep, right, rim ones, right? We're talking like oceanic ones. A lot of those won't fire up until the price goes up. Price goes up, oil exploration goes up. Your companies like Borr Drilling, I haven't looked at Borr in a while, but Borr is a drilling company. My guess would be that Borr Drilling is up as oil price. Oh, there you go. Yahtzee. That's my point, everyone. That's my point. So now, like companies like Borr Drilling, which are about oil exploration, they're now going through the roof. Why? And look at their chart. They were a bad one. Still a bad one. Just saying. Just throwing it out there. Throwing it out there. It's still a bad one. I wouldn't touch Borr Drilling. I just threw that out there just so that people would just kind of see what I was talking about. Michael O2. Great one, Michael. Thank you for this one. Michael O2 says, we've gone from masks to helmets. Oh, I like that. That's a good one. Thank you. Brad Miller chimes in. We should stop locking things down. Treat it like the flu at this point. Get your annual flu shot if you want. If you don't, then you might get the flu. The worst variants are behind us. Or, I got an even better idea. How about everyone starts becoming healthier? How about everyone starts drinking more water, exercising more, going outside more, breathing fresh air, eating less fast food, eating less processed food, losing weight? Oh my God. You're telling me to be healthy is the best thing that any of us could have done our whole lives? Holy crap, no, but instead the government is sitting there telling us, no, lockdown, be inside, don't do anything. Nope, masks, forget it. Nope, forget it. Nope. Kids can't go to school, forget it. And the kids suffer. I'm super lucky, all right? I'm super lucky. I live in South Carolina. My kids they only missed out on school, I think it was March, April, May, and June of 2020. And Marquise, thank you with the 1-up. Is that a Super Mario 1-up? Because if it is, that is really, really freaking cool. Thank you, Marquise, for that. My kids, I'm so lucky to have lived in South Carolina. My kids have not been locked down in school. My son is very sensitive. Some of you guys have seen my son on cam with some of the videos. My son is a very sensitive kid. It really affected him being sent home from school. Now that he's physically back in school, I'm watching this kid make just beautiful relationships with his friends. I pick them up every day at school. Make sure I'm still good time-wise. Yep, I'm still good time-wise. There we go. I'm just making sure. But my kids are in school. I pick them up and their friends every day. In fact, you guys are going to laugh at this. I can't even make this up. There you go. There's my daughter texting me to remind me to let her know. I don't know if it's in focus because I've got a lag. Saying, hey, make sure you get me at 3:15. I will respond back to my daughter in a very loving manner because I am a great dad. I'm going to respond back to my daughter, you suck. Just for fun. Just for fun. Just for fun. Oh, that's the stocks one. Gotcha. All right. Hungry hippo. All right. I like that. This is exactly the thing. Khalid Muhammad says the same thing. They won't tell you the truth, just like this is a currency war. Yes, Khalid, let's be real here, everyone. If Russia wanted to really show everyone and flex what they could do, all right? If they wanted to flex what they could do, they could have made this the bloodiest thing we have ever seen. This is about the setup of finance and global control of power and money. And Ben, thank you again, Ben. I think I'm going to have to remove Ben. I'm going to probably have to remove Ben from his donations because, Ben, you're above and beyond, dude. Can I do that? Can I ban, can I put, a financial ban on, our strongest member? Am I allowed to do that? Because, seriously, Ben, dude, you do a lot, man. Seriously, you do a ton, dude. You really do. You really do. Twitch Radio says, I went out and studied the Amish for about 1.5 years and learned as much as I could from their years of working hard and learning how they live for themselves, and honestly glad I did. In Twitch Radio, dude, it's totally true. It's exactly right. It is exactly right. You have to take care of yourself. You have to take care of yourself health-wise. I watched pictures of Ben and Jimmer, all right? Ben and Jimmer, all right? You guys are going to love this. Ben and Jimmer just did vacations where they were outside. Camping, hiking in the snow, all that kind of stuff. That is what we need. We need people taking care of themselves. We need people, doing more for their health. You know, it's very frustrating, and I feel so bad because everyone out here is panicking about crypto, and it's I get it. I understand panicking about crypto, but then are we patting ourselves on the back for all the other investments that we bought in, the oil and precious metals? Khalid Muhammad says, we're going to sanction Ben, everyone. Thank you. That's what we're going to do. Khalid Muhammad says, you'll be doing what they do, banning. We're going to allow Ben to participate on the channel, but we're going to sanction his monetary pull so that he can no longer donate to the channel. But it's true. We all have to take care of ourselves, and that's why this channel has a really strong core group of people. This channel has a real strong core group of people that understand the bigger picture. All right, and think about this. All right, look at this. I got this up on the screen right now. I played this as a teaser. All right, yeah, no more Swift for Ben. Hey, Ben, nope, Ben has to go to BRICS now, everyone. We're pushing Ben to BRICS. That's the new rule on the channel. No more Swift for Ben. We're going BRICS. But I have this up on the screen. It says Colorado will start accepting cryptocurrency for tax payments. All right, and Marquise joining in the channel. Thank you, Marquise. The support is awesome. Thank you, everyone. But look at what I got up on the screen. Colorado accepting cryptocurrency. So even if the feds, right, on a federal level, like the big umbrella, okay, let's talk feds, big umbrella. As long as the feds kind of drag their feet, and we've seen that, states are going to come out. And Colorado is a Democratic state. In fact, Marquise, did you see that real quick? Hold on. I gotta, did you guys, Marquise, did you see this one? There was a thing in Illinois, and I saw this yesterday. Yeah, Illinois legislation would allow a digital currency as a form of payment. So we're seeing Republican and Democratic states coming out there. All right? Come out with their own rules because the government themselves are taking too much time. All right, so there is a little bit of politics involved with crypto, but it's way less than what people think, because I even saw an article of someone out in California wanted to do the same thing. This is big. This is big for everyone. All right, so for all of us out there, hey, sweetheart, how are you doing? Sorry, my doggies are bugging me. For all of you out there that watch this and know what we've been trying to promote on the channel, we're trying to promote realism. Let's refresh this up on the screen right now. You guys saw, I've got the poll up here. And real quick, is everyone cool with the new name? Is everyone cool with that? And Marquise, I got it up on the screen, bud. I got you right here. Illinois legislation would allow a digital currency as a form of payment. How cool is that? Even in Illinois. and Ben chiming in, it's my pleasure, mate. You do all the hard work. I'm humble, and it's like those that watch, I'm very humble with all this. I'm very humble by the support. Seriously, I'm so humbled by the support that I have from everyone here on the channel. This is super, super cool. But this is the kind of stuff that we have to share with everyone. All right, this is what we all have to start telling about each other. Now, one of the things that I wanted to show you guys, all right, sorry, my doggy, my little sweet doggy is hanging out with me, all right, is this. And again, everyone, let me know, what did you guys think? Channel new name, you guys like it? I got some goodies up here on the screen. Look at this, so we have the vote. Check this out. Again, 25% of the people that have voted have said, no, the Fed will not raise rates. That is dangerous. That is a danger. Seriously, I swear to God, when I did this, I posted this during the hearing that we were watching, right? And I hope you guys like that format. I turned the camera off and I went hardcore on chat so I could chat with you guys so that you guys could listen and read. Hopefully you guys like that format. But look at this. I mean, I posted this during the meeting, and right now, 25% of people basically are saying they're not going to raise rates. Are you serious? Like, are you seriously serious? Like, this is no way. No friggin' way. Like, how is this? And this is what I'm talking about. This is where I think the realism has to match the expectation, right? You remember we always talk about expectation versus reality? Like, that's kind of like our thing, okay? Look at this. So now let's check this out. We have a quarter of the people saying no raise, a quarter of the people saying they're essentially going to raise it a quarter, a fifth of people saying a half a point. I'm honestly leaning in the half a point. This is really where I'm leaning in the half point. All right. It's a small percentage saying 3/4, and a quarter of the people saying they're going to drop a big hammer. A big hammer. Michael O2 chimes in, the only thing to bring down inflation is the housing market. Michael, it is so much deeper than that. All right, we're gonna reinstate Ben's talking privileges real quick for everyone out there, because we can mute his mic, or not his mic, we can mute his chats too. Oh, we're gonna sanction Ben. Oh, I've got new sanctions on Ben. That's it. I already know what I'm gonna do. But look at housing, okay? Look at what's happened in housing. This is crazy. Right? Let's just go near term on housing. Let's go real near term. Look at these spikes here. And look at the spike, right? From your winter, all right? Let's go Q1 of 2021. $418,000 average price for the sale in the United States. And in 2 quarters, that went up almost $58,000? What, 15%? A 15% increase. And remember in the wintertime, okay, for those of you out here that are watching that aren't from the United States, in the winter is when our housing prices kind of cool off. Even during the winter, housing prices increased from $473 to $477. It is bad. This is really, really bad. Ooh, stagflation. Ooh. Hey, Marquise, what about this? You remember how they said more and more people are saving money? And because more people are saving money because of inflation, or more people are saving money because of fear, what's happening? The more cash that you build up, inflation just chomps it, because inflation is rising faster than what your cash is worth. Oh, levels of madness. Yes, levels of madness. I don't know. How the heck are you guys commenting on what I'm talking about so quick? Levels of madness says, I keep getting offers to buy my crib sight unseen. I think investors just want to get out of cash fiat. Yep. The best thing you could do right now is buy distressed properties under market, because people are generally lazy right now in the housing market. And distressed properties, you can still buy them. They're wedge properties, right? You can still get them for under value. Fix it up yourself and make a killing on it. Make a killing on it. Ben says, yes, the new name is a big improvement. And just so that you guys know, it's not just a name change. Here, I'm gonna move it just so you guys can see. I'm gonna go bottom left-hand corner, so hopefully it doesn't freak anyone out, right? It's not just a name change, guys. But it's also some logo action for everyone. So it's crypto with Klaus stand out from the crowd, and of course, anyone. It's Michael O2. We've got more sanctions for Ben. And anyone that's ever hung out with me in person, you will probably have the best time in your life. You will probably have one foot in the grave, but I'm always going to ask you at the end, after you hang out with me, but did you die? That's what it's all about, guys. And seriously, thank you everyone out there. I was so nervous when I did this switch with the name. I was afraid I was going to lose people. I did. I took a hit. I took 5 subs right off the bat. As soon as I switched the name, I lost 5 subs right away, but we gained them back. We gained them back real quick, so I was super, super happy about that. Michael O2, who is probably going to be our finance minister going forward, says, just make Ben a mod for your show and he'll stop donating. Oh, that's a really good tool. See, I think what we're learning here, we're learning that sanctions can be very, very useful. We just have to apply them to the right people. Khalid Muhammad, commercial property will take a big hit. Yes, commercial property actually took the biggest hit, period, during this whole thing. Because remember, a lot of people started working from home. Commercial property, like that asset class was like the hardest one. Was like the hardest one. So let's just tie everything together, all right? Crypto, we know it's going to be beat up for a while. When you watch channels that tell you billions and billions and billions and billions and all that stuff, no, that is not the AOL logo. I know what you're talking about, but that is not. That's the guy looks like that. Remember the guy? He looks like that, but that is not the AOL logo. Yeah, and Marquise, exactly right. Commercial real estate. So Marquise, when you're looking at homes out there, and you're looking for commercial on ground floor and residential up on top floor, you're going to get a way better deal, especially if you buy a property that needs to be fixed up. You're going to have a wedge property that's going to totally supply your family with insulation for the next coming years. Marquise, you're doing the right thing, man. You really. I know what your plan is. You know, like in a broad level, and you are doing the right thing. But right now is not the time to freak out about crypto in a weird way. Is crypto getting pummeled? Yes, of course crypto is getting pummeled. But so is everything else. So are tech stocks. Has anyone looked at Tesla lately? Like, has anyone looked at Tesla? Look at Tesla as your best thing. Tesla, all right, has lost how much of their value? About 50%? That's an expensive pint of beer, Ben. That is a very expensive pint of beer. But look at Tesla. Before the Rona happened, and real quick, can I talk to everyone about this? Let's go on a weird tangent, okay? For those of you think that, sorry, my dogs are freaking out. For those of you that think that crypto can't do anything big, look at what Tesla did. Tesla was trading 60, 70 bucks. They split. I think it was a 4-1 split. I don't remember offhand. It was 2-1, 4-1. I don't remember. All right. But they went up to 1,200. It's all possible. The reason Tesla blew up, look at what happened since the Rona in March. Tesla just went on fire. Yeah, screen and screen and screen and screen. Did you guys like that? I went like super screen and screen on that one. But this is all part of it right now. Okay? You just have to find assets that are beaten up, and you have to find assets that have good balance sheets. You have to be with a good balance sheet. Ooh, Marquise is going, I'm having it built up. Modular commercial. Ooh, that's a nice idea. Ooh, I like that. That's actually a really good idea. So there's things that we can do out there, all right, to insulate ourselves from what is going on. Now, what I'm going to do here, I'm going to end the stream at 2 p.m. I still have to work out today real quick before I pick up my kids. In Twitch, I can tell you, cloud computing was a good year for me last year. And then what happens is, right, we get out of that stuff, we wait till the rotation to happen again, we invest in new things, boom, we go forward. That is how it works. That is how the whole investing thing works. Don't put your eggs all in one basket. Spread it out. Spread it out, spread it out, spread it out, spread it out. This is the best, safest thing to do. Wigbusta chimes in, very big money in India, and they are adopting crypto quick. And remember, I'm glad you brought that up, Wigbusta. Remember, India was one of the countries out there that said they were going to ban crypto, only to come out a few weeks later where their government's saying, no, we're not going to ban it. We're just going to tax it to 30%. The moment they taxed it 30%, boom, their whole crypto adoption in their country rose. In fact, their wallets, right? They had like a 30 or 40% increase of people signing up new wallets the moment they said they were going to tax it and legalize it through that function. That is what we're needing in the United States. Right now, what is the one thing, and you guys, we've talked about this. You guys remember like how I drew the hitbox on Stellar sub 30? And remember I told you the longer we go without a Biden executive order, the longer we go with turmoil, all right, the more it's going to drive prices down. Remember, Biden said, and his administration said, we're going to have a crypto executive order in February. February has come and gone. And let's be real here. Should what happened in Ukraine have changed anything with U.S. crypto policy? No. No, no, and no. But what really has me worried right now is an executive order overreach, right? Biden wants to appear strong. So if Biden appears strong with crypto, right, and he uses crypto like as his way to be strong because he knows that a lot of people are funneling money through crypto, there could be an overreach where he then says, you know what, we could do X, Y, and Z to crypto. That could be a huge buying opportunity for us. A huge, huge buying opportunity for us. Right now, right, if we just specifically look at Stellar, let's just zoom in. You can see Stellar is struggling to break that 20-cent mark. They are struggling to do it. All right? They are struggling to do it. And real quick, I wanted to chime in. Ben said something. Ben said, 5 pounds is not a lot of money here. It gets me 1 pint of beer. That is, like I said, Ben, that's an extremely expensive pint. But I just wanted to say again, thank you, Ben, for all the support. Super, super, super thank you. Put you on the spot again, man. I'll put you on the spot. We're not going to sanction you just yet, Ben. We're not going to sanction you. We're not going to ban you from SWIFT just yet, but we are going to say thank you. Thank you, and seriously, thank you to everyone out there. I mean, this is cool. Totally cool stuff here. So yeah, let's do this. I'm gonna start pulling off on the stream. I still need to exercise. I'm going to Colorado, and I think I'm like 5-6 weeks away from when I'm going to. I think I'm like 5 weeks away from going to Colorado. I'm getting really close to being in peak performance when I get out there because I'm going to definitely need to be. We've got good conversations going on. I've been super happy with all the participation from all the fans, all the channel members, all the support in Discord. It has all been huge. And again, if you haven't, go check out the main channel page. And remember, whenever you hang out with me, I guarantee you will have a lot of fun, but you will not die. Go to the main channel page and check out the vote. Let me know what you think. Let me know what you think about this. How much are the feds going? They said it today. They said they're going to raise rates in March. They said that today. The question is, how big are they going to raise rates? If they raise them a 1/4 point, will the markets kind of be like, oh, okay, whatever. If they raise them a 1/2 point, are you going to see an immediate drop and then bump up? That's what we need to look at. The Fed, and just so those of you that know, FOMC meeting calendar, I'm almost positive, yep, it's March 15th and 16th. This is the date. I got it up on the screen. That's what you have to watch out for. That is what you have to watch out for. Ben R says, I don't think this bear market is going to last too long. There are so many new users coming into crypto. The time-served crypto traders like us have learned the hard way. Yes. Thank you, Ben. Yes, exactly right. And that's what's going to happen here, okay? What's going to happen is all of us that got kicked in the teeth now, right? Tell me out there, are we not better off as a community after going through all this? Yeah, Marquise, I'm at a 1/2 point too, man. That was my guess. My vote is the 1/2 point. That's seriously where mine is right now, is the 1/2 point. If they come out with anything under a 1/2 point, holy crap, is that going to be a problem? I do not think a 1/4 point is going to slow down the machine right now. I do not think that's going to happen. Australia, yeah, we have to figure out what's going on with Australia. Simon and I talk about this. We have to figure out what's going on with Australia in crypto. But right now, we've learned a lot of lessons. Do you guys remember this? Do you guys remember last year, 2021, when crypto was just booming? This was way unsustainable, man. Way, way unsustainable. All right? Twitch Radio says September is my guess for when crypto will go up big time. Just an educated guess. Yep, around ISO. And honestly, once we get past with oil and gold, seriously, we have to get past oil, gold, precious metals, safe haven assets. But right now, I'm telling everyone right now, you have to be super careful. The oil market is bigger than you can ever imagine with its pull on the entire economy, global economy. As gas rates go up, okay? Where's Ben at, all right? Ben, you know that $5 pint of beer? I know a $5 pint of beer isn't a lot, but if your petrol costs keep going up and up more, that's less and less beer money. That's less and less crypto money. And I think that's what's going to happen. You're going to see people across the world now with food prices, gas prices, housing prices, all that going through the roof. You're going to see less money available to buy your crypto, less money available to buy beer, less money available. No. We're going to make money for beer and we're going to make money for video games. No worries, guys. We're going to be cool. ISO is still scheduled for November 2022. Yep, we haven't had a full rollout schedule, but yes, they're still targeting November 2022. Which is also the same time for the U.S. midterm elections. Oh, kind of something to keep in mind. But yes, keep an eye on the oil market. Keep an eye on the gold and precious metal markets. Gold above 1900 is telling you right now everything you need to know about safe haven assets. Be very, very careful right now. I have not purchased any crypto in a few weeks because I have a real good feeling I'm going to be able to buy a heck of a lot more in the near future. A heck of a lot more in the near future. In fact, if I time this right, I'll tell you guys all right now what I'm going to do. I'll tell you guys all what I'm going to do, and then I'm going to log off so you guys can all like either make fun of me or think I know what the heck I'm talking about. I am going to take my money that I am making in all my gold stocks and derivatives, and I'm going to liquidate portions. So as my gold gets up to like crazy high rates and as my gold derivatives get to crazy high rates and I get some really big money out of that, I'm going to take little chunks of it and I'm going to use it to buy beat up crypto assets. I'm going to rotate my profits from here and I'm going to roll them into the assets that are beat up. That is how you become a contrarian investor. It's planning, it's timing, and it's getting kicked in the teeth all day long. All right, everyone, this is what we're going to do. I am going to sign off right now. I need to exercise because I am way behind the 8 ball time-wise. So, yes, Klaus from Crypto with Klaus. Thank you very much, everyone, for your participation. Thank you to the new channel members out there. Thank you for the super chats, super stickers, donations. I totally appreciate it, everyone. And honestly, everyone out there, be ready. Look out for Saturday. I'm going to have some live streams on Saturday when I go play Pokemon Go in DC. I am going to guarantee you, I am going to show you all right, some stuff about DC you have never seen before. I will show you things the news won't show you, and I will be able to share pictures, videos, and all that from my trip. And yes, I will be live streaming from DC as well. So Klaus from Crypto with Klaus, God, I couldn't even say that. I will catch you all later. And again, thank you everyone for your support. I sincerely appreciate it. As of now, we are not sanctioning Ben with removing him from the